And here are your top stories. Investors wait for PMI data from France and Germany dropping this hour. That's as global stocks head for their worst week since March. US jobless claims climb to the highest level in nearly 2 years, suggesting a cooling job market. Meanwhile, Treasury Secretary Janet Yellen sees the risk of a US recession diminishing. Plus, stubborn UK inflation and the Bank of England's shock 50 basis point hike piles more pressure on the mortgage crisis facing millions of people up and down the country.
Tom, let's take a look at the futures. So a dollar climbing, traders on watch, of course, for some kind of verbal intervention on yen, but a lot of the focus is on what central banks have said this week, and that's overall pushing up bond yields, heightening fears of a recession, and the FTSE futures down some 0.3%.
Yeah, and that angst has been etched into these equity markets at the global level, at the Asian level, and across Europe. We're setting ourselves up for 5 straight days of losses in Europe when it comes to European stocks. And again, for Asia, the worst week that we've seen this year. Globally, the worst week for about 3 months. So the pressure on the equity markets is there on the hawkish rhetoric and the action coming through from those central banks. The FTSE 100 opening this Friday, June the 23rd, currently down 0.2%, again, following that shock increase of 50 basis points. And what it means for the Bank of England, how many more jumbo hikes are in the pipe for the central bank as they wrestle with the highest inflation, core inflation in the G7 by some margin. The CAC current over in France down 0.5%, and in Spain, the IBEX is off 0.7%, dropping 64 points. Let's switch it over and see how things are shaping out cross asset then. We do have, by the way, some data coming through in terms of Spanish GDP in the first quarter, increasing 0.6% quarter on quarter versus the prelim number of 0.5%. The estimate had been for 0.5%, so a little bit of an improvement there in terms of Q1 GDP. But as you can see, Spanish stocks are down. Futures in the US then pointing lower on the S&P E-minis by 0.4%. Jay Powell just reiterating again in that testimony yesterday that 1 or possibly 2 hikes could be coming from the Fed. 4,406 for S&P futures. Here is the 2-year then, up 1 basis point, 480 now on the US 2-year. Bitcoin just holding above that 30,000 level, but down 0.5%. Of course, the rally that we've seen for the cryptocurrency has powered it higher above that 30,000 level, and it just holds above that by the skin of its teeth at this point. Brent down again, 0.7%, just the pressure again on oil markets, concerns about recession, concerns again about China, which is on holiday, but that lack of fiscal stimulus down $73 a barrel, and year to date, Brent off by about 15% year to date. Francine.
Now, this is what else we're, of course, looking at. Some of GlaxoSmithKline. Actually, we have some breaking news. GlaxoSmithKline settling some Zantac cancer lawsuits, and that's set for a trial in California. I don't know whether it's having a huge impact on the share price. Again, the share price just opening, so maybe we need it to settle a little bit. It's gaining some 2% after we settled. Of course, they settled that with some of the people that were taking them to court. Now, the Bank of England stepped up its inflation fight with a half-point hike, unexpectedly raising its benchmark interest rate to 5% yesterday. The 9-member MPC backed the move 7 votes to 2 and signaled further tightening could be needed to tame the UK's persistent inflation. For more, let's bring in Jamie Rosh, our Chief Europe economist. I can't talk today, Jamie, at Bloomberg Economics. So, Jamie, if you look at the BOE, I'm all over the place, a little bit like the mortgage market. I mean, how much does that mean they can still do from here? Was it a jumbo hike and then they wait in the summer, or they just keep on hiking?
No, I think they probably will keep hiking. But if you think about the reasons for the move, they were spooked by wage growth coming in much stronger than they expected and core inflation going up rather than down. And again, surprising to the upside. So I think it was a response to those particular data points. If the data cooperate for the rest of the summer, which means core inflation stays broadly stable as we were expecting, then I don't think there'll be the same urgency to act, and you'll get 25 basis point hike in August. But, you know, we were wrong about inflation, we were wrong about the bank. So, you know, we'll see what happens over the summer.
Okay, well, there's a mea culpa there, and there's a lot of economists who are going to have to be doing that, including at the BOE, of course, in terms of those inflation forecasts. Jamie, what about the mortgage market? I mean, this is dominating the front pages now. How bad is it?
Well, what do we worry about with monetary policy? We worry about reaching a tipping point that causes a recession rather than a slowdown. And you don't know when you're reaching one of those until you get there. And we might now be there. I mean, with the mortgage market, with interest rates where they are, pricing for mortgage loans at 6% for a 2-year fix, probably heading higher, it's a massive change. And it's also different from the last time we saw this, because during the trust period where rates went up, everyone thought, well, as long as someone gets on top of this situation, things will return a bit more to normal. No one's really thinking that now. I think people are thinking, oh, the Bank of England's going to have to keep rates very high for quite a long time. This is here to stick. I need to factor that into my life choices. So I think that we are facing a different situation now in the mortgage market, and I suspect that there will be further developments there.
Across Europe, we have French and German PMIs this hour. What are we expecting, Jamie?
Well, I mean, the PMIs have generally painted a picture of fairly resilient services sector, pretty weak manufacturing, and I think that's the broad picture that we're seeing. I mean, the PMIs have, generally speaking, overstated the rate of growth over the past 6 months or so, though. So I think even if you get a good reading, we shouldn't feel too optimistic about it, unfortunately.
Okay, Jamie Rush, Chief Europe Economist at Bloomberg Economics, and that data, at least the first set, will drop at 8:15 UK time. A redhead crossing the terminal. Wow, what a hit for Siemens Energy as they withdraw their profit guidance on more issues. And this has been a long-running question and challenge for Siemens Energy around its Spanish renewable energy unit, of course, Siemens Gamesa, and the stock plummeting 35% after Siemens Energy withdraws its profit guidance on those issues that it continues to have to work through, Francine.
Yeah, so basically, this is after a review of Siemens Gamesa's installed fleet and product designs that revealed that because of quality issues, they have to pay in excess of 1 billion euros. So this is what we heard late last night, but actually not a lot of people were expecting a 35% drop. I think we're expecting like a 15-20% drop. So maybe analysts are seeing other things in there.
Okay, let's bring in our guest now to talk through the markets with a particular focus on the UK and the asset reaction to that surprise 50 basis point increase, of course, from the BOE yesterday. Diana Robinson, Head of UK and Ireland Investments at JP Morgan Private Bank. Diana, good morning. Thanks for joining us in the studio. To what extent is this a central bank that is losing its credibility, and are you now bracing for further jumbo hikes from the BOE?
So yesterday was actually, in our view, quite a positive day. We feel like the Bank of England got ahead of where it needed to be in terms of communication, saying that they were going to clearly fight inflation. The 50 basis points, while not expected, people said, oh, it should happen, but it won't happen. And yet it did. So actually, yesterday, very good move from the Bank of England.
Sorry, is that the first of many? Or is this 150 basis point, and then they go back down to 25? You expect more 50s to come through?
I don't think that's clear. We think there's another 100 basis points probably to come. How that pans out is not exactly clear. I don't think it needs to be another 50. It can be more measured. I think the important thing between now and the next couple of weeks is probably the communication. One of the things that people have, I think, been concerned about with the Bank of England and Andrew Bailey is that it hasn't been clear communication ever since really 2021.
Yeah, I mean, it's difficult because the way the MPC works is they each have a voting right. So actually, Andrew Bailey himself doesn't know what it ends up being.
That's right.
I know he's getting a lot of flack for actually communication, but just the way it works, it's very difficult for him to forward guidance. This is all about inflation. So inflation for the moment, if you look at forecasts, still expected to be 6% by year end and then 3% somewhere in 2024. Is that still your base case?
Our base case is that the economy in the UK is going to slow. We don't think, if you actually look at the rate of growth of the underlying growth of the UK economy, it's really interesting. There's almost like a disconnect now between what people are expecting the UK to grow at. If you look at a 6% Fed funds rate, BOV rate, and then you look at the US pricing and Europe, I mean, the UK is not a fast-growing economy. We think its growth rate post-GFC is something like 1.5%. Its interest rates are being priced as if it's 3.5%.
But it's interesting. I mean, you're sounding very sanguine, you know, on the back of this, and you're predicting 6% interest rates and a slowing growth. But you're not seeing a deep recession then in the UK, despite what we're seeing in terms of the turmoil in the mortgage market.
Correct. We don't see rates staying that high for that much longer. Our forecast is that the economy is already slowing. If you look at some of the incoming data, some of the producer price index, so the inflation is slowing, we do think that the Bank of England is going to be where it needs to be, stay ahead of the curve, and the economy will slow as it needs to do in order to lower inflation, lower interest rates, and unfortunately have higher unemployment along the way.
Diana, how much do we, also rely on what's happening in the U.S.? So our colleagues over in Paris yesterday caught up with Janet Yellen, and they talked about the recession. So I think we have a quote board on what the secretary said in terms of her expectations for a recession going forward.
I thought that was surprising.
It was surprising that she's not I mean, she's basically saying a recession is not her base case.
Yeah.
But she's watching for interest rate hikes.
Yeah. That's surprising. Our base case in the U.S. is that we get a recession. We think the recession starts at the end of this year. We think it's a modest recession, 3 quarters, relatively narrow.
Yeah, but the Fed, how much more can the Fed tighten from here?
We think the Fed needs to tighten maybe one more 25 basis points, but you're already seeing the signs of slowing growth. You're seeing that in senior loan offer surveys. You're beginning to see that in employment. We do need to see employment come off. 225,000 payroll each month is not sustainable at this point.
Okay, despite that forecast on the U.S. economy, you would, am I right? I think you buy the dip. I mean,
yes.
U.S. equity, in global equities, it's been a rough week.
Yes.
You'd be buying at this point.
Yes, we would be buying the dip.
Explain.
So I think it's important to remember that the economy is not the market. We think we've seen the worst of the stock market has been behind us. We have had a much stronger risk asset moves up this year than we had anticipated, but it's been quite narrow. If you look at the U.S. market, if you take out the big AI-related names, the market is really quite flat. We actually see earnings starting to grow sometime in the middle of 2024. We think the market is forward-looking, and it will start to reflect that. So we would be the buyers on the dips.
When, Diana, when does it start to reflect what you're talking about? Third quarter or earlier?
When does the market start to reflect that? Well, it already has reflected some of that, but I think it really starts to take off probably as a bumpy next 6 months and then higher.
I mean, I feel like the market has kind of been all over the place, right? I mean, one day they latch on, one day they don't believe what Fed officials are telling them or what central banks are doing, and the other, they think recession is coming because of higher interest rates. So markets seem to be a little bit like tugged between these rock and a hard place. So it's difficult to call it bottom.
I think that's right. It is difficult to call the bottom. I wouldn't want to say that I'm calling the bottom. I think we've seen the bottom. Yeah. I don't think we'll see another big decline from here. You know, it's important to keep in mind we look at our clients and how they're invested. And right now, most people are still sitting in cash. Cash still looks very attractive. There's a lot of money on the sideline. We think that's going to come in. Most people are underinvested in equities and they're underinvested in bonds.
Yeah, that Bank of America survey pointed to that. About 25% of their base, at least within that survey, not deploying into US equities at this point. So Diana, bring the optimism on Friday and what has been a pretty rough week for equity, saying buy this dip. Diana Robinson, really appreciate it. Thank you. Head of UK and Ireland Investments at JP Morgan Private Bank. Let's come back to what is happening. It's not a positive picture when it comes to Siemens Energy. The stock tumbling after it pulls its forward guidance. More problems around its renewable energy unit, Siemens Gamesa, of course, over in Spain. So that stock dropping 30%. We'll keep across that story for you, of course, Fran.
Coming up, we get a lot of European data shortly, including French PMIs. So we'll look at the numbers and what that means, of course, for the ECB's grip on the economy. That's coming up shortly, and this is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Recession, you have to find the right balance between coming back to sound public finances and keeping a high level of investments in the fight against climate change and, of course, in defense, since we have war back on the European soil. This is this balance that we want to preserve. You know that we are in the process of defining the new rules for the European countries, the Stability and Growth Pact. We want those new rules to keep the right balance between investments and sound public finances.
All right, that was the French Finance Minister Bruno Le Maire speaking to us yesterday on the sidelines of the Summit for a New Global Financing Pact in Paris. We talked about risks of a recession and, of course, some of the pension reforms.
And on risks of a recession, getting a little bit more in focus for us as the redhead crosses on France. June's services PMI, I'm starting with services because that's where the pain is, falling to 48, so in contractionary territory, firmly in contractionary territory, below that 50 level. The forecast was for 52.1. Services down to 48 in terms of PMI services for the month of June for France. Manufacturing a little bit better than the forecast, but still in contractionary territory there, 45.5. The forecast was for 45.3. Euro taking a hit, down 0.6%. Again, it's services where the pain is being felt. 48 in contractionary territory. The forecast, 52.1. Let's bring in Bloomberg's Zoe Schneeweis now in Zurich. Zoe, the reaction from you to this data out of France as we look ahead to Germany as well.
Yeah, this is quite devastating data, isn't it? And in the statement from S&P, there was the clear statement that this actually would mean that France would be contracting in the second quarter. That France, which, as we know, avoided a winter recession, would actually contract 0.5% in the second quarter. So that's very bad. That's very painful. We get Germany in 15 minutes. Then in 45 minutes, we get the euro area. Both the Germany and euro area, as a reminder, did have winter recessions. Germany economists generally seem quite confident that will be avoided in the second quarter. But obviously, France is doing this badly. Let's see how that feeds through. Not a good day.
Yeah, not a great day, certainly not also for the ECB, who have to put together monetary policy. Zoe says, does it deter them in hiking further?
It might. It just shows them, in a way, it presents them with the bill of what it means to hike interest rates this quickly and at such a fast pace and such a high level. Overall, the issue is here that initially, everyone says the ECB has to hike because of these inflation data. But sooner or later, then companies say, actually, if it costs this much, I'm going to stop investing. And all that then means that there is a hit to the economy. again, they had thought initially that, or the idea of the worry of recession had been avoided. But then when those numbers came out last month that showed both euro area and Germany had happened, that kind of just reminds them this is the cost. France now is is an awkward situation, and obviously also a slight embarrassment here for Macron that while he's hosting this big summit, then data come out that suggest that his economy is actually in contraction.
Zoe, thanks so much. Zoe Weiss there in Zurich with the very latest. Now, coming up, we'll hear from Kenya's president saying the country will redeem half of the $2 billion Eurobond that's due next year. This is a huge deal for investors and, of course, for the country itself. So we'll hear more from that interview with President William Ruto. That's next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, probably I try and play that role.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Long-term debt will free resources for us to deal with the urgent matters of climate change, of renewable energy, of making sure that the children go to school, that we have food, all those issues. If we can achieve that, and I think it is not asking for too much, because it is a win-win. The multilateral development banks don't write off the debt, they just reschedule it. The borrowers, like the rest of us, have to pay it, but we get a breathing space of between 5, 10, or 15 years. That way, we can deal with the immediate. And if we deal with the immediate, then we can concentrate on reforming the multilateral development institutions or transforming the multilateral development institutions. Number one. Number two, the second outcome we're looking for is a new architecture that will deal with climate financing. From where we began in 2015 with the Paris Agreement, where we managed to forge a a global consensus that we need to reduce emissions by 45% by 2030, and we need to be net zero by 2050. For us to achieve that, we need to make sure that we eliminate the current tension. We have to walk away from north versus south, emitters against non-emitters. We have to walk away from developing to developing and develop. We must walk away from that. And we must get a new global financing system, which have been proposed already. We just need to agree on them. Global carbon tax, aviation tax, financial transaction tax, maritime tax. If we agree on those four, we can collectively put together between $1.5 trillion and $2 trillion for climate change, and we can easily begin the journey to walk towards a net zero globe by 2050.
Well, that was the Kenyan President William Ruto speaking to us on the sidelines of the summit for a new global finance pact in Paris.
Okay, welcome back to the Open. 24 minutes, of course, into the European trading day. You're seeing losses across the European benchmark of what? A little over 0.1%, but the action really is in the bond markets and on euro-dollar on the back of disappointing services PMI for the month of June coming out of France, now in contractionary territory at 48. Euro-dollar down almost 0.7%, currently a little over 0.6%, and a sell-off in terms of euro-dollar. But the money moving in to German debt, yields are down almost 10 basis points on the benchmark 10-year, 239 on the German 10-year Bund, yields down 10 basis points.
Now, the other story we're watching out for is, and it's a pretty incredible story, is Siemens Energy. Shares falling some 36%. This is after it took its profit guidance out of the market. So it's basically withdrawing its outlook due to mounting issues at the Spanish wind turbine unit, Siemens Gamesa Renewable Energy. And this is, look, it's been coming for some time in terms of costly problems that they've uncovered at the wind turbine unit. The latest was a review of some of the installed fleets and product designs. And that review revealed that they had fixing quality issues of its onshore wind products that would lead to huge costs in excess of €1 billion. So on the back of that, they withdrew the outlook, and the share price now getting pummeled 31%, a third.
Okay. I don't know how we did the segue from renewable energy to chocolate, but it's worth noting. Hotel chocolate also slumping as they see earnings lower than market expectations. So that's one to watch as well. Hotel chocolate, of course, lower on the back of a bit of earnings disappointment. Now, Twitter needs to increase its resources if it wants to comply with new European regulations ahead of a deadline in August. That's according to Thierry Breton, the bloc's internal market commissioner. Breton says there are a few, quote, critical areas that the social media platform needs to focus on immediately.
He made very clear that he will comply with our regulation, and that he believes that DSA is a good regulation, and this is what he wants to do. So again, I proposed to all of them, including Twitter, to run a stress test in their headquarters to make sure that they will understand what they have to do to be ready. He accepted. He's the first one, by the way, to accept it, which is, of course, a good sign.
Thierry Breton, the EU Commissioner for Internal Market, speaking exclusively to Bloomberg. Coming up, we'll continue, of course, the conversation following the Bank of England's price hike with former members of the MPC committee. He's Andrew Sentence. This is Bloomberg.
Half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. French services PMI unexpectedly contracts, the euro slides. Investors are still awaiting purchasing managers' data from Germany and the euro area. Siemens Energy shares plunge after the company pulls its outlook over escalating issues at its Gamesa renewable energy unit. And U.S. jobless claims climb to the highest level in nearly 2 years, suggesting cooling job market. Meanwhile, Treasury Secretary Janet Yellen sees the risk of a U.S. recession diminishing.
And it's more soft data out of the Eurozone. Germany, June services PMI falling to 54.1, well below the forecasts of 56.3. Still in expansionary territory, but well below the forecast. 54.1 is the number in terms of services PMI for the largest economy in the Eurozone. Manufacturing PMI falling as well, 41, so significantly into contractionary territory. The forecast was for 43.5. Again, that's June manufacturing PMI for Germany, 41, services PMI, 54, and euro-dollar falling like a stone. Currently, you're looking at euro-dollar at 108, down 0.9%. We'll check in Bunds as well. There we go. The move into German debt, even more pronounced than it was just a couple of minutes ago after that French data. Yields now up, I should say down 13 basis points as German Bunds are bid. The benchmark 10-year 236, yields down 13 basis points.
Now, the Bank of England surprised with an unexpectedly large 50 basis point hike a day after data confirmed that core inflation is still on the rise. Now, traders have raised their expectations for further hikes, seeing the terminal rate exceed 6% by December. Let's bring in Andrew Sentence, former MPC member of the Bank of England and senior advisor to Cambridge Econometrics. Andrew, as always, thank you so much for joining us. When you look at what we heard from the Bank of England yesterday, were they right to do 50 basis points just to get upfront and placate markets?
Yes, I think it was the right thing to do. I think the context for this latest move is the Bank of England started raising interest rates too late in 2021, right at the end of the year, and was a bit slow in terms of recognizing the severity of the inflation surge that we've seen. So they're playing catch up to some degree. I'm not sure that this half-point rise necessarily justifies some of the market expectations. I think the MPC will take things on a month-by-month basis or a 6-week-by-6-week basis as they reach each meeting and assess the data. But if inflation doesn't start coming down much more decisively, yes, I would expect to see further interest rate rises.
Andrew, when it comes to the market pricing, you're suggesting that maybe markets are a bit over their skis in terms of pricing 6.25 for the terminal rate by the early part of next year. Of course, it's going to be dependent on the trajectory of inflation. What is your current estimate, your current forecast around core inflation in the UK by year end?
Well, in terms of core inflation, I would hope we'll see some reduction. So currently it's running at 7.1% in terms of inflation excluding food and energy. And we really want to see it coming down to the sort of level that they've got in the United States, which is just over 5% by the end of the year, I would have thought. Obviously, if we can do better than that, that would be even more impressive. I think the core inflation is obviously one of the key indicators that people are looking at, but the thing that I'm focusing on much more is services sector inflation. Basically, the inflation that we've seen so far has been mainly concentrated in the goods sector. Energy is part of the goods sector. Manufacturing has been quite significantly affected. Now, if you look at producer prices in the UK, that goods inflation, manufacturing inflation is subsiding quite quickly. But what's not happening is that's being followed by services sector inflation. In fact, services sector inflation is going the other way.
So, Andrew, where do you see, so overall, where do you see, do interest rates go to 6% by year end, or is that a little bit too high?
I think that it's premature to make predictions about. I know people in financial markets have to do it, but I have the luxury of not having to do that. I think we will see further interest rate rises, but where they'll quite take us to, I think, is still up in the air. It depends very much on the performance of inflation and also, obviously, how the economy is performing. We've seen today with retail sales figures that the retail sector, at least, is relatively robust. So that is a bit of a mixed blessing for the MPC. On one side, they can say, well, we haven't damaged the growth of the real economy with our policies, but on the other hand, it may be an indication that demand is still relatively strong.
Yeah, you have to wonder how long that demand's going to hold up as people face up to these sky-high mortgage rates. Andrew, what is your assessment then? Bloomberg Economics says we get to 6%, but then we're firmly kind of in recession. That's it. That tips us into recession and pretty consequentially. Is that your view as well? I mean, what's the depth of the downturn for the UK on kind of 6% level?
Well, on a technical definition of recession, two consecutive quarters of GDP decline, I wouldn't be surprised to see that. But I would also expect, if there is a recession of that sort, for it to be fairly mild. The economy has been relatively resilient. I would actually more focus on what's happening in the labour market and the extent to which some of the heat in the labour market begins to ease. And that doesn't necessarily require a recession, but we need to see vacancy rates falling. We need to see employers finding it easier to recruit. And we also need to see, more crucially, an easing in wage pressure. Obviously, if those things don't happen, then it's likely that interest rates are going to continue to go up further and the risks of an outright increase.
What does a policy mistake look like right now? Too much interest rate hikes or too little? If you look at what's happening with, the Eurozone economy, I know it's a different economy, I know we're in different cycles, but actually you started core inflation going down a touch and then you have some pretty ugly PMIs. So what if all of these interest rate hikes are just being delayed in being filtered through the real economy?
Well, I think there are two slightly conflicting pressures here. One is the need for the Bank of England to demonstrate that they're taking inflation seriously and taking the necessary action. But also it is the case that the way in which the bank rate now feeds through into the economy through mortgage rates in the UK seems to be a much slower process, which is why I think the MPC will be looking at things on a month-by-month basis as they approach each meeting to decide what the best thing to do is. So that's why I'm not rushing to judgment about exactly where interest rates are going to peak out or by when.
Andrew, have they lost credibility? How much credibility has been lost at the BOE?
Well, I regard this as a sort of long-term issue. In my mind, the Bank of England has lost credibility over a longer period, going back into the Mark Carney governorship. And I think the three rather crucial mistakes were made. One is not to make a more serious attempt to raise interest rates in the 2010s, when the bank talked a lot about raising interest rates, but really didn't do anything substantial. The highest they got up to was 0.75%. And then they put in too much monetary stimulus during the pandemic, particularly through quantitative easing. And thirdly, they were then very slow to row back that stimulus and to raise interest rates in 2021. Quite a few economists, including myself, were saying in the summer of 2021, this surge in inflation looks like it's going to be much more significant and sustained. It took the bank another 6 to 9 months to come round to that conclusion, and they were slow in starting raising interest rates, and they were rather timid in raising them in the first instance.
Andrew, how much of a nightmare is this for mortgage holders?
Well, it depends on people's individual circumstances, but if you've got a mortgage, you obviously don't want to see the cost of it going up, particularly when you've got other price pressures to deal with. Hopefully, some of those other price pressures will start to ease. I mean, they have done to some extent already. So we've come down from a peak of 11.1% inflation down to 8.7%. The energy price situation is looking more favourable now, though we're going to go into the winter when it's affected by seasonal factors. And there's some tentative signs that the food price inflation may be easing. But mortgage holders don't welcome interest rate rises. The only thing I would point out is that as long as the banks are pushing through these higher interest rates towards savers, there's another constituency in the economy, quite an important constituency, who will then benefit. And so from a macroeconomic perspective, those two things will create more of a swings and roundabouts effect for the economy.
Okay. Andrew Sentence, really appreciate your time and your analysis on the back of that BOE decision. Of course, former MPC member of the Bank of England, pointing to what he describes as a 3-point or at least 3-factor erosion, gradual erosion of the credibility of the Bank of England, and commenting there on the damage in the mortgage markets. When it comes to central banks, the ECB now, this is interesting, traders pricing in an ECB peak below 4% for the first time since Monday. Of course, the deposit facility is currently at 3.5% for the ECB. Again, traders pricing in ECB peak below 4%. That's for the first time since Monday. German Bunds are bid. Yields are down 13 basis points on the 10-year after softer services and manufacturing data, PMI, out of both Germany and France for the month of June. Euro-dollar down, currently close to 0.9%. Fran.
Tom, coming up, Siemens Energy falls by a record after withdrawing its profit outlook. We look into the issues found at its wind turbine unit. That's next, and this is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to the Open, everyone. 45 minutes into the European trading day. Across the board, we're seeing pressure. The European stocks down 0.4%. And then the FTSE is interesting because it's only down 0.7%, but it does mean that it's erased all gains from the start of the year. A couple of things we need to watch out for is, of course, we talk a lot about mortgages and the fact that interest rates will probably go to 6%. That at least is what's priced into the markets. And so let's also look at the banks. If you look at mortgage markets, 95%, for example, loan to value bucket, it remains important for house prices. It also remains important to the banks. A lot of the chief executives' banks will also meet officials at number 10 today to discuss the way forward.
Yeah, gilts are bid yields coming in about 7 basis points at the front end, still holding above 5%, but the pound is under pressure, as you said, of course, our UK stocks year-to-date flat now on the FTSE 100, 7,450. One of the biggest losers over in Europe is Siemens Energy, and their shares are plummeting more than 31%. A record drop, by the way, after scrapping its profit guidance. That is after its wind unit, Siemens Gamesa, found worse than expected quality flaws and its onshore turbines. Let's bring in Bloomberg's JP Barnett in Frankfurt for the latest on this. JP, how bad is this then for Siemens?
Well, it's super bad. I mean, we know that the unit had issues for the last couple of years with profitability. Now we have this added problem of quality control at the unit. And what's more is that the company is not really giving us any details on how they're going to fix this. They said it will be more costly, it will take more time. And we all know if you give investors uncertainty, especially surrounding your profits, then they crater your stock. And well, that's what's happening right now.
So what does it mean going forward, JP? Are they expecting things to be even worse if they just withdrew their outlook, or does it mean they need a couple of days to work it through?
Well, the feeling from me is from the press release that we got and from the comments from the management this morning is that they don't know themselves what they're actually going to do and how long it will take and how much it will cost them. Because if they would know, they would give us at least some numbers and some guideline about the timing. And that they haven't tells me they don't know, and that's a big issue. It means they will look into this like probably for weeks and months before they can give us a clear idea of how they're going to fix this. And that's something that investors really don't like, and I really don't understand from a management perspective either, that as a company you can't really tell the people like, okay, we have to do A, B, C, and this is going to cost us X, and then we fix it, right? That's the normal way of how you deal with those quality issues. But given that the company has not done that, it's really bad, and I'm sure investors will have to deal with this for a couple of weeks and months now.
Yeah, that pressure is going to build, as you say, isn't it, for a plan, at least to be outlined by Siemens Energy on how to deal with these challenges. JP, what else is standing out to you? I mean, is Siemens Energy, is this an idiosyncratic story? It sounds like it is a bit. I mean, what else is standing out to you in another week of pretty significant downside for these equity markets?
Well, absolutely. I mean, like the main story for me in general equity markets, and Siemens Energy here is a good example, is that investors have pushed aside like all the risks over the last couple of days and weeks. A recession is basically only on the horizon, and a very mild one, a very minor issue, and everything is good. Everyone has piled into stocks again. Everybody is like rather bullish for overall sentiment, believes that company profits will hold up well. We have all the AI and technology stuff that is overlaying that bullishness and adding to the positive sentiment. And when you have a market environment like that, and now moving into the summer where volume is notoriously low, then that's never a good combination when you have like bad surprises.
All right, JP, thanks so much. Jan Patrick Barnett there with the very latest on Siemens. Now, coming up, Ukraine's prime minister plays down concerns that future aid flows depend on its success on the battlefield against Russia. We'll have that exclusive interview just ahead, and this is Bloomberg. So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
It's second conference for Ukrainian recovery. The first one was held in Switzerland 1 year ago. Today we are in London. 62 countries and international organizations are here. Hundreds of businesses are here, international businesses. We feel tremendous support from all of our partners. We feel financial support, sanctional, military support, humanitarian support. Results of this conference have a long-term consequences. We have many promises. We have many concrete agreements, declarations, memorandums. We have financial support. We have middle-term program for Ukrainian support from European Commission, from European Union for 50 billion euro for the next 4 years. We have tremendous support from United Kingdom. We have very good meetings with our partners and with United States Secretary of State. We have very good conversations, negotiations, and very good results.
And yet, while all of this is happening, we know that back home, the fighting continues and the counteroffensive is going. And I do want to make something very clear. Was there at any point in this conference, did you get any hint that anyone suggested the funding will depend on the counteroffensive.
Absolutely no.
If it's successful, more money. If it's not, it would be less. No one told you that.
We have very, very sustainable, very strong, and very unwavering support from our partners. There is no dependence from results on the battlefield.
They are entirely different.
Absolutely. We have very strong messages, especially on that conference. Ukraine is future member of EU. Ukraine will be supported by partners. Russia must pay because of these consequences of this war, of terrible war and aggression from Russia's side. So these messages from partners are very supportive, are very promising, and now we continue our counteroffensive. This is not easy walk. This is not Hollywood movie, as our president Volodymyr Zelensky said yesterday.
Yesterday, he seemed a little bit exasperated. This is not a movie. It takes time. It takes patience.
Absolutely.
Is that what you feel at times too? This is not Hollywood. It's real people and it's lives.
Yes, and every life is very important for us. And we are not Russia. We are not Soviet-style army when they bring their lives to the fire of the war. So we are very careful. We are very smart. We use NATO standards in this war because we are fighting according to NATO standards. We are fighting for weaponry of NATO countries. And counteroffensive, it's multiple operation. It's offensive, it's defensive operations, it's tactical pauses. So it will take time, but we have first results.
It's too early to make an assessment.
Absolutely.
Now, that's what you say.
We have first results of our counteroffensive. 8 villages are liberated. More than 113 square kilometers is liberated. 7 kilometers go into the head from the front line. So it's very important results for the 2 weeks, and we will continue.
And sir, of course, now you have, you're on Bloomberg TV, of course, you have the investment community that's watching this interview, but you also have a lot of taxpayers, some of whom are very sympathetic to Ukraine too, but they say we want to see value for money, but also this idea of corruption at times. I remember President Zelensky said, my government will crush the oligarchs. We will be a before and after moment in Ukraine. Is that the moment or the message that you're sending to people? Things are changing in Ukraine.
Ukraine is changing, absolutely. President, our government, we have zero tolerance to the corruption.
You will ditch people that are corrupted if you find anyone.
We finished formation and creation of our anti-corruptional infrastructure together with our partners.
Well, that was the Ukrainian Prime Minister speaking exclusively to Maria Tadeo. He is, of course, Denis Shmyhal.
Okay, let's check back on these markets and the action really in terms of bonds. That is the focus as traders and markets start to reassess just how far the ECB can go on the back of that softer than expected data, PMI data out of France and Germany. So German bunds a bid, but you're getting a move into gilts as well. German bunds on the 10-year, 235, yields down 14 basis points. And in the UK as well, at the front end, the 2-year back below 5%, 4.97, yields down 10 basis points, down 12 basis points on the 10-year. Euro dollar also under pressure, again, on the back of that weaker than expected data. 108 down 0.8%. Stocks down 0.2. Futures in the US pointing lower by 0.5%. Surveillance Early Edition is up next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it,
The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Global stocks head for their worst week since March, and the euro falls after dismal PMI data from Germany and France thrust the threat of a recession back into focus. U.S. jobless claims climbed to the highest level in nearly 2 years, suggesting a cooling job market. Meanwhile, Treasury Secretary Janet Yellen sees a risk of a U.S. recession diminishing. Plus, shares in Siemens Energy plunge after it took back its profit guidance due to mounting issues at its Spanish wind turbine units. Now, first thing is first, so let's check on the markets. A lot of the focus, of course, is on those numbers, what it means for global interest rates. And we're also getting those euro area June services PMI falling to 52.4. That's falling more than expected. We had forecasts of 54.5. It's coming in at 52.4. Now, remember, everything above 50 still indicates a, well, not a contraction expansion, but is lower than expected. What this means is that watch out for yields. Yields overall had already sunk on the previous PMI data, which is France and Germany. It's basically heightened investors' concern about a recession. Investors today definitely fleeing into the safety of bonds and sold some of the stocks as there's a lurch towards this higher interest rate through the week. And this week, manufacturing data heightened anxiety that higher rates will tip economies into a recession. We're also seeing a repricing of what the ECB could do from now until year end. Euro dollar, let's look at euro dollar if we have it. There you go, 108.72. And the rally in European bonds also sent the 5-year German bond yields plummeting as much as 15 basis points to 2.49%, really putting them on course for the biggest drop since April. Now, to talk about all of this, joining us, Bloomberg's Zoe Schneeweiss in Zurich. So, Zoe, break down the data for us. How complicated does this make it to understand the impact that interest rate hikes so far have had on the economy?
Well, we've been seeing an impact from interest rate hikes on manufacturing for months now. What we now are noticing is that services also are being impacted, and that means that the overall number just stayed about that vital 50 number that separates contraction and expansion, but still it's very close to a stagnation. So that overall, if we remember, the euro area did have a winter recession, a very mild winter recession, minus 0.1 in the fourth quarter and in the first quarter, but that was a recession. Now, we were hoping for a rebound this quarter. These numbers just show that this will be a very, very weak rebound, and it just shows that this is the price you pay. This is the price the ECB was willing to pay when they went on this unprecedented tightening spree that started almost a year ago.
So what does this mean for what the ECB is looking at? So if you look at philosophically what central banks do they pause for a bit to really try and see exactly where it ends up? Or does it have more of an impact on inflation if they keep on pushing ahead and then stop in September?
So if we look at the inflation expectation or the inflation suggestions from these PMI numbers, they show that if it was only about controlling goods inflation, the ECB now could be clinking glasses and cheering. The issue is services. In services, inflation prices still are getting stronger. And that is just very bad news for the ECB. So that July rate hike, that supports them in the July rate hike. Overall, when you think about the whole way that the ECB moves the economy, influences the economy, the idea is that if the economy slows down, that will actually feed through and also feed through to prices. But these data just show that this is not quite happening, especially this feed through to service inflation is something that will be worrying them, as the underlying inflation gauge that they look at has a big services component.
Zoe, thank you so much. Zoe Schneeweiss, of course, stays with us to discuss all of these central bank intricacy. Also joining us, Thomas Viladek, Chief European Economist at T. Rowe Price. Thomas, thank you for joining us. If you look at what the ECB has been doing, has been saying, and some of the fight against inflation, do we have a definitive or close to definitive answer on how long it takes for some of the price hikes to get through? And so what should the ECB be doing in this kind of situation?
So there are certainly lags, and I mean, yesterday in the statement, we saw the Bank of England admit that second-round effects are more persistent in response to these inflation pressures in Europe, and I think the ECB is in a similar place. So just because we saw these weak real economy data today, as far as I know, employment data there is still quite robust. I think it is quite possible that the ECB will continue to be hawkish, and it is still quite possible that we see a 4% interest rate from them in September.
Okay, so markets are definitely, and I want to get also Zoe on this, but Thomas, it's very clear that the markets are now saying, look, we're worrying about the possibility of a recession. Are markets overreacting, or are we going to see also ECB members thinking the same?
So I think markets are right to be worried about a recession. My own forecast suggests that European services PMIs will fall even further from here, mainly as a result of the pass-through from the tight macro-financing environment the ECB has created in the past couple of months. So I think they're right to be worried. However, we have to remember that the main target of the ECB is price stability. And what we really need to be watching is momentum in services inflation. If this doesn't come down materially over the next couple of months, it is likely that the ECB will just continue reacting to the inflationary data more than the output one.
Zoe, what's your take on this? Again, I know investors are fleeing into the safety of bonds and they're selling stocks, but this is kind of what the ECB wanted, right? They need to slow down the economy enough to get down inflation. Otherwise, they can't do it.
Yes, but as just was said, the issue is here that the slowdown is not working on services inflation, and that is something that will give the ECB reason to be concerned. Obviously, you're going to Sintra next week, and you'll be speaking to probably everyone on the Governing Council, and what I'm expecting them to say is, yes, July is happening, but then the question really very much is September. My guess would be that they will be quite hesitant, except for those quite pronounced talks, that most of them probably will say it's just too early to commit to September. We've got several inflation prints. Sintra actually next week is timed not ideally because you've got 3 days in Sintra, and then on Friday you don't get the inflation print for June until the Friday. And then you'll also, so they'll have, they won't just have, that will help determine the July move, but then before September, they'll have another 2 prints of inflation. They also will have new forecasts for September. So all that are things that will probably make a lot of the central bankers say, September, we just can't say at this point. And let's, again, committing now, you do have to be quite a pronounced talk to commit that far in advance.
Yes, it's very difficult at the moment actually to have a clear picture of what happens. I mean, when you look at services inflation, does it come down? I mean, is there, you know, I know this is a surprise, but if you look at how inflation came up, is it not just going down in the same manner? So you see some of the manufacturing or inflation we're seeing in manufacturing first and then services comes later. Thomas.
So I think that depends on the survey. We're just inferring from the PMI survey this morning. But the European Commission survey actually suggests that services inflation may stay elevated for a little bit longer. So I think it's very highly uncertain at this point in the cycle when we see this, the survey services inflation transmit into the actual data, and the ECB will react to the actual data. It is entirely possible that the next two services prints in the euro area surprise markets a bit to the downside, but equally, it could happen that they are persistent or go even higher. It's hugely uncertain right now. That's why the ECB isn't willing to commit. However, what we do know is that they will put emphasis on the actual price inflation data more than anything else in the September decision.
And Zoe, I understand that, of course, we're in different cycles compared to the US, but one piece that really caught my attention this week was John Authers saying, look, the great inflation scare reaches its final phase, and he's, of course, talking about the US and inflation in the US appearing in the last lap. Like, talk to us about, I guess, how reliant US inflation or how markets are interpreting US inflation and how that relates to inflation in Europe.
There always is the issue here of the gravitational pull of the Fed, that the ECB can very well say we've got our own inflation to watch, but in a way, what the Fed does, it does influence them quite massively. So the ECB hiking much longer than the Fed would be very unusual and would be one of those things that they could though be in a way forced to do this if inflation now stays too strong. Overall, going completely different to what the Fed does when the Fed has stopped or maybe already is thinking about cutting will be something that would be a premiere from the ECB if they actually manage to go their own way on that.
Yeah, and Thomas, do ECB officials get influenced at all by what happens in the Bank of England? I guess this is not the first central bank, right, in the last 2 weeks to surprise to the upside in terms of hikes. So does it change the narrative, not only looking at these figures, but just looking around you, whatever the other major central bank is doing?
So I would say that the inflation problem facing the Bank of England is unique to the UK because they have a much, much tighter labor market than in the euro area. Yeah. Most of this is just structural issues. So I would expect inflation here to be much, much more persistent than in the euro area, and hence the Bank of England is now reacting to these data as well. So I think we need to be aware of this important difference. Yeah. Having said that, central bankers, of course, do talk to each other. There are panelists at Sintra next week from the Bank of England. So there's always some spillovers, cross-contamination in terms of thinking about inflation.
All right, thank you both for joining us. Tomasz Wiladek, their chief European economist at T. Rowe Price, and Bloomberg's Zoe Schneeweiss. Now, coming up, Treasury Secretary Janet Yellen sees a lower recession risk as U.S. jobless claims climb to the highest level in nearly 2 years. So we'll get into that next, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, U.S. jobless claims figures climbed to the highest level since October 2021, suggesting that the labor market may be cooling somewhat. Meanwhile, Treasury Secretary Janet Yellen is sounding more optimistic about the chances of the U.S. avoiding a recession. Now, for more on all of this, we're joined by Bloomberg's Jill Dices in Hong Kong. So, Jill, good morning. Why is Janet Yellen so optimistic, or more optimistic?
Right. Well, yeah, let's take a look at those comments from Yellen. So she was speaking to us and saying that essentially she sees the risk, if anything, of a recession going down. And I'm sure she's looking at, actually some pretty promising data that's come out fairly recently out of the U.S. We saw some home construction data earlier this week that was pretty strong, suggesting that that's going to contribute positively to GDP growth in the second quarter. We also got some pretty good retail sales data pretty regularly. But it's also, these comments are pretty interestingly timed because she also just said that the labor market has been resilient, and at the same time we have this new jobless claims data that suggests that jobless claims are remaining quite elevated. I do want to say, Bloomberg Economics took a look at some of this and said, yes, some of that data is some of those jobless claims are really concentrated in just a few states, and ultimately, even though they see the labor market is cooling off, they've described it as kind of a gradual cooling this year. So, and I will also point out that Bloomberg Economics has pushed back their expectations for a recession a little bit, seeing something maybe hitting in the back end of this year. But I think what all of this is really telling us is that this is a very sort of tricky situation. We've seen with Jay Powell, just talking to lawmakers this week, and even what he said in the FOMC presser last week, that what the Fed's doing to target inflation, how it's balancing that against the economy, and whatever the economy's resilience may be, that's all a very sort of flexible situation. And I think that that's really important to keep in mind here as we get these kind of new comments from Yellen about the state of the economy, as we look at all of this data, is that ultimately it's just going to be a very interesting year ahead as we sort of plot out how exactly the economic outlook works here.
So, Jill, walk us through the new capital requirements also for banks that Jay Powell discussed on Capitol Hill.
Yeah. So look, this is he was talking to lawmakers yesterday, and this is sort of a long-standing program that we've been talking about since the 2009 financial crisis, right? Is sort of addressing lending with some of these big banks. I think that this really kicked up in earnest earlier this year when we saw some of these banking failures, and I think that's put a lot of scrutiny on here. So what Powell was ultimately saying is that he did shed a little bit of light here, saying that the largest lenders on Wall Street probably could face an increase of about 20% in what they have to set aside. He did make the point of saying that would likely apply to the 8 biggest banks rather than some smaller banks. But it's important to also remember that there's a lot of details that would still need to be worked out with any kind of a plan. So it was really interesting hearing that from Powell, but ultimately I think we're still going to need some details on how exactly that program would come together before we move forward.
All right, Jill, thanks so much, as always. Bloomberg's Jill Dice is there in Hong Kong. Now, shares in Siemens Energy have plunged after it scrapped its profit guidance due to mounting issues at the Spanish wind turbine unit. It's the latest in a long line of costly problems uncovered at Siemens Gamesa Renewable Energy. Now, for more on all of this, we're joined by Bloomberg's JP Barnett in Frankfurt. So, JP, what do we actually know about what they found out?
Well, the thing is that we know very little. The company only told us that they did a deep technical review and that they discovered that it will take longer and cost more to fix those quality issues. But it didn't give us a timeline, they didn't give us an amount, or they didn't give us much details to work with. And that's why we see shares plunging here by about 30%. Because what can investors do if you give them uncertainty? Nothing but sell the stock.
So, JP, when do we find out what happens next? If you look at the stock, so it's down some 28% as we speak. They withdrew this outlook because they basically had a review of some of their installed fleet and, think that some of the quality issue means that they'll have to pay in excess of 1 billion euros. Could it be even higher than that? Do we find out in 3 days, in a month? Like, what exactly is going on?
Yeah, I would love to know that, and I hope that the decline in the stock price is now a warning shot for the management, that they give us more details. I mean, you can't just like announce that you're restoring your profit guidance and then give investors nothing to work with. I mean, you have to come out now in the next couple of days, a week or two, the latest, and give some idea like, okay, this is our game plan. We expect this and that. I mean, they stick to their revenue guidance. I mean, that's some good news here, at least from the company. But this bad chunk of information that they've put out now into Nirvana, they have to put some boundaries around it and tell investors what's going on, and they rather do this sooner than later, I would hope for.
Okay, JP, thanks so much, JP Barnett there in Frankfurt. Coming up, the World Bank is pushing for more private sector investments in emerging markets. We'll explain the new initiative next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
China could do more to make itself understood, but on the other side, I would like to say the outsiders should also work hard to understand China. It's very interesting. Ever since the China opens up, Chinese people have tried very hard to understand outside the world. The same kind of response, could also be needed.
Well, that was the AIIB president, President Jin, speaking to us exclusively at the Summit for a New Financial Pact in Paris. We also spoke to the World Bank Group President, Ajay Banga, and Mark Carney, co-chair of the Glasgow Financial Alliance for Net Zero, on the initiative to get more private sector investments to emerging markets. This is an exciting
planet, which includes climate and fragility and pandemics and food security and an unnecessary
war in Ukraine. When you put all that together, there's no way that there's adequate money in the governments or philanthropy or the multilateral banks. You have to bring in the ingenuity and the capital and the technology of the private sector. That's what we are trying to harness, but doing it in a way that brings people who know the private sector, understand its risks and management, and those people come to help us do things better.
How fast and with what kind of money?
What kind of money? Well, real money. And how much money? There's various estimates, but if you look at external financing, the increase in external financing into non-China emerging and developing world, it's something on the order of an extra $1 trillion a year, certainly by the end of this decade. So we need to rapidly scale it up, but we also need to generate a lot more domestic finance as well. So it's about domestic reform as much as international.
Is this enough to make a real difference? So first of all, what are the chances of this, being locked up or locked out fast? And does it go to the projects that need to be?
Well, the idea here is that I believe that if you take renewable energy, I do believe that now the cost per unit of renewable energy is below that of fossil fuel. The question is therefore, why is it that the private sector would not want to invest in those in the emerging markets? Part of it might be capitals going to the developed world, but part of it might be the risks they see, macro, FX, other such things, securitizable vehicles. There's a whole series of things that we think this group can help us learn from, and then we can do things together.
So why has that not been happening naturally?
Well, let's go back 2 years ago. 2 years ago, only a third of global emissions were covered by country net zero commitments. Now it's well over 90%. 2 years ago was 1,000, 1,500 companies had net zero commitments at science-based targets. Now it's 10,000, and on and on and on. So the world is now moving very rapidly. But what that exposes is that it has to be all the world. It has to be all the emerging markets and very much the developing countries, and it has to happen in a way that's going to yield growth and poverty reduction alongside climate transition.
Our economies are pretty fragile. Does that complicate things, actually moving capital?
Well, look, actually, I think I have maybe a different view of the relative strengths in the economy. My view is that we are on the cusp of an investment boom in the advanced economies across much of the emerging world, and the issue is to make sure that that happens everywhere, and this is what we're working on.
Well, the World Bank President, Ajay Banga, and our co-chair of Glasgow Financial Alliance for Net Zero, Mark Carney, speaking to us from the summit, New Global Financing Pact in Paris. Now, that summit, of course, is still going on in Paris with Secretary Yellen just speaking. She did speak and catch up with some of our reporters on the ground talking about recession in the U.S.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economic activity in the euro area almost came to a halt in June with dismal PMI data from Germany and France. U.S. jobless claims climbed to the highest level in nearly 2 years, suggesting a cooling job market. Meanwhile, Treasury Secretary Janet Yellen sees the risk of a U.S. recession diminishing. Plus, shares in Siemens Energy plunge after it took back its profit guidance due to mounting issues for the ECB. We'll also be in Sintra live next week, where all of the ECB Governing Council members will speak about exactly, well, what the way forward is for a lot of these. So your area, June manufacturing PMI coming in at 43.6. The forecast was 44.8. And then we have UK PMI, also extremely interesting, although some of the PMI figures are a little bit backward looking. And of course, the Bank of England has troubles on their own because of mortgage rates and the fact that the market is now pricing in a 6% interest rate for the end of the year. All right, UK June services PMI falling to 53.7. That's below estimates. Manufacturing PMI pretty much as expected. When you look at inflation, when you look at some of the eco data, again, there's this pull and put between services and manufacturing, and it's unclear what that means for inflation having to go down going forward. Now on to tech, and Twitter needs to increase its resources if it wants to comply with new European regulations ahead of a deadline in August. That's according to Thierry Breton, the bloc's internal market commissioner. Now he says there are a few critical areas that Elon Musk's social media platform needs to focus on immediately.
He made very clear that he will comply with our regulation, and that he believes that DSA is a good regulation, and this is what he wants to do. So again, I proposed to all of them, including Twitter, to run a stress test in their headquarters to make sure that they will understand what they have to do to be ready. He accepted. He's the first one, by the way, to accept it, which is, of course, a good sign.
Well, that was Thierry Breton, the EU Commissioner for Internal Markets, of course, talking about Twitter needing to comply with the Digital Services Act. Now, Ukraine's Prime Minister, Denis Shmyhal, told Maria Tadeo in an exclusive conversation it's too early to make an assessment on the Ukrainian counteroffensives, while playing down concerns that future funding actually depends on this military success on the battlefield against Russia. This is a conversation he had with our European correspondent, Maria.
Messages from partners are very supportive, are very promising, and now we continue our counteroffensive. This is not easy walk. This is not Hollywood movie, as our president Volodymyr Zelensky said. And counteroffensive, it's multiple operation. It's offensive, it's defensive operations, it's tactical pauses. So it will take time.
Well, Maria joins us now. So, Maria, it was a great interview. It was an extensive interview. And, of course, he was in London for this reconstruction package. He says that funding is not pegged to military success.
And it's such a difficult question, Francine, because on the one hand, they really try to talk about the economy and rebuilding Ukraine, and yet We talk about the war, and we know the counteroffensive is going on, and this is a brutal war. I mean, he said it himself. It is critical, and it's a tough war. It's not going to be a Hollywood movie. I asked him 3 times, however, do you feel there is a connection between the money and the success on the battlefield? Will the money decrease if you don't do well on the battlefield? He told me 3 times, no. And I asked in every possible way that I could. He really tried to shut down that conversation. But do they feel pressure? They do. They know that allies want to see gains on the battlefield. They know there's an election happening in the United States next year. The United States has pumped billions into this war, so they do feel it has to go well. But again, the war, it's unpredictable. It's tough.
So how's the counteroffensive actually going for Ukraine?
Yeah, and I asked him that question, and he told me it has been going on now for 2 weeks. There was a secrecy as to whether it's fully on now. He did tell me a counteroffensive, it's not a Hollywood movie again. It's a number of different operations. It's defensive. It's offensive, too. He did say perhaps some expected that this was going to be fast. Obviously, now there's an understanding that they did not make the quick gains that some were hoping for. But he also said, we're not going to do what Russia's doing, just throw money and people and do a massacre. We can't do that. We're not going to fight it Soviet style. And they still say, we're not done yet. We continue, and hopefully it's successful for them.
Maria, thank you so much. Our Bloomberg Europe correspondent there, Maria, today with the very latest, of course, on this important conversation she had with the Prime Minister of Ukraine. Coming up, we'll discuss how poorer countries are facing the greatest threats from climate change. We'll bring you more from our exclusive interview with the French Finance Minister. That's next, and this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We don't want the poorest countries in the world to be confronted to a choice between fighting against extreme poverty and fighting against climate change. We want to provide all the financial means for those countries to be efficient in the fight against poverty and in the fight against climate change. This is the key purpose of this summit, and I think that the key point, the key purpose, would be to define a new financial architecture for the 21st century.
Minister, are you frustrated that it's taking this much time? I know the Chinese premier is here, which is a great coup because we haven't actually seen U.S. officials and Chinese officials at this high level in a room together talking about these issues. But you've tried to push also voting rights in the IMF. How's that going?
Big things need a long time. So I'm not frustrated. I think that we are totally determined with President Macron to have a final positive outcome for this summit. I think that we are moving on the right direction as far as debt restructuring is concerned. We want to move faster, we want to move quicker. I think that we could have a positive outcome as far as the debt of Zambia and Sri Lanka is concerned. It is really quite good news to have the Chinese Prime Minister here in Paris today, talking with all the head of states, talking with the Secretary General Yellen. This is really, I think, a very positive outcome. We also have the new president of the World Bank, and we are defining a new role for the multilateral development banks, providing more money for the poorest countries. So really things are moving on the right direction, and the final outcome must be positive.
Minister, I imagine that in the corridors they talk about trade. They talk about the fact that Secretary Blinken was in China, the fact that we have President Xi with a rapprochement with the U.S. What does this mean for global growth?
I think it's good news because we all want to improve the relationship between the three continents, between China, the US, Europe. We are totally determined to defend our own economic interests in Europe. You know that the new principle, which is now at the core of the European future, has been defined by President Macron, and it is sovereignty. Sovereignty means that we want to defend our technological assets, our economic interests, while talking with China, but being aware that there is a necessity to really have all the necessary tools to defend our economic interests.
French Finance Minister Bruno Le Maire there speaking at the summit for a new global financing pact in Paris yesterday. Now, also at the summit, Kenya's president, who told me that the country plans to repurchase at least half of its $2 billion Eurobond that's maturing in June 2024 before the end of the year. Now, President William Ruto also issued a warning to speculators.
The people who are looking for how to make a kill from this, they think they can scare us and create a narrative around it. I want to promise them that we are going to redeem half of it before the end of this year, and we will square it out by the time lapses in June next year. We are in a good space.
Well, that was the Kenyan President William Ruto speaking to Bloomberg. Meanwhile, Zambia has reached an agreement in principle to restructure $6.3 billion of debt with bilateral lenders. It sets a precedence for a growing list of countries struggling to service their liabilities. Well, on Twitter, Zambian President Hakainde Hichilema called the agreement a significant milestone. Joining us now from the summit in Paris is also Rajiv Shah, the president of the Rockefeller Foundation. Rajiv, thank you so much for joining us, or I should call you Dr. Shah. You've been a leader on all of these issues for quite some time. Are you confident that this will lead to something more concrete? I know Emmanuel Macron has done a great job in bringing people together and keeping the momentum going, but now it needs to be a transfer of money if we're going to get real stuff done.
Well, thank you for having me. Look, this Paris summit is extraordinarily important because it is an admission by world leaders that we are failing to fight climate change around the world in a way where we're providing funding to allow dozens of economies to transition their economies to a better climate future. And if we continue to fail, we'll see what we've seen in the last few years. More poverty, more people that live without access to electricity, more coal-fired generation being financed and brought online, and greater threats to all of us that our world will be uninhabitable. So I applaud President Macron for bringing folks together. I applaud the 30-plus world leaders who have come to Paris. And yeah, I do think there are some specific outcomes related to specific pieces of progress that are important and a good first step. Unfortunately, it's not quite enough, and so this will have to continue well beyond just the 2 days in Paris this week.
So what are you expecting concretely by here until the end of the year? And Dr. Shah, I know the conference very well. I was there yesterday, so we're looking at world leaders, and you're literally like 5 meters away from them. Do you see a resolve from these world leaders to also transfer funds, or is it only talk?
Well, I do expect a few specific outcomes that will be an important step on funding. So 14 years ago, the world leaders committed to provide $100 billion to help countries around the planet fight climate change. For 14 years, they have not met that commitment. I think thanks to this summit, this year it'll be the first time they do actually meet that commitment. We've seen prior commitments on some technical issues called special drawing rights. I think more countries will donate special drawing rights to allow for very poor countries to invest in fighting climate change and protecting their people. We've seen progress on things called loss and damage waivers, so then when loans are provided to countries to pay for their infrastructure, if they're swamped and overwhelmed by extreme climate events that are just devastating, they get a break in having to pay back those loans until they can recover, and then they can pick up their repayment. These are incremental improvements. They are not enough, but they are the output of a lot of political leadership offered by the French President Macron and others, Prime Minister Mia Mottley of Barbados most notably, and I think they're a good first step towards real transformation.
A first step is only a first step. Where do you think we'll be in 2 and 3 years? And again, given all of the political pressures, economic pressures, inflation, cost of living, do you think, Dr. Shah, that we're taking a step back in trying to find solutions for these important things that we need to deal with?
Yeah. Well, you know, I think, frankly, given the rise of populist politics all around the world, if we didn't have these types of summits, we would be continuing to step back from our commitments to especially the world's most vulnerable people. You know, the impacts of climate change are far worse if you're in the Horn of Africa and you're suffering from hunger and malnutrition. They're far worse if you live in coastal Bangladesh and you're dealing with rising sea levels. They are far worse if you're a climate migrant from the Northern Triangle region of Central America trying to make your way to the American southern border. So these are problems we can solve with the right strategies and the right investments. To your question about what should we seek 2 to 3 years from now, what we should really seek is new public-private partnerships that provide trillions of dollars of investment so that everyone can participate, not just in the crisis, but in the opportunity. You know, renewable energy is a huge investment opportunity in wealthier economies. It's not yet a lucrative investment opportunity in lower income economies. We need to change that. Battery storage should be available to economies all over the planet, not just in China, Europe, and the United States. We should have electric vehicles and electric buses, and the jobs that are created by manufacturing them should help lift up people and communities. Everyone should get to participate in the upside of the climate transition. And what I'd like to see is what the Rockefeller Foundation is focusing on, is getting more private investment and public-private partnerships so there can be thousands of development projects that are about renewable energy. They can create millions of jobs, and they can lift up those people who have otherwise been left out of and not given a fair shot at growth and opportunity.
Dr. Shah, what needs to happen from finance? And we saw this private-public partnership, certainly the World Bank under the helm of the new president trying to spearhead a little bit of movement on that front. But has finance played a fair role in this?
Well, so far it hasn't actually played enough of a role. I mean, if you look right now, developing countries in particular represent a very significant credit and foreign exchange currency risk for investors. So what I would urge the new World Bank president, Ajay Banga, and Mark Carney, who is helping him address the challenges of private finance, is to learn from things that are working. The Rockefeller Foundation, the Bezos Earth Fund, and the IKEA Foundation created the Global Energy Alliance for People and Planet. We've mobilized $11 billion and have launched more than 30 projects in more than 16 countries in just 18 months. That's working because it represents real blended finance, private and public together, to do things that make sense for everybody. Build out solar parks so that you can provide electricity, but also create jobs with local manufacturing of solar panels. Build out battery storage on grids in India and Africa and Latin America so countries can take more renewable intermittent energy in a cost-efficient way. These are the solutions of the future, and frankly, those that now lead these institutions that were created after World War II to reconstruct Western Europe have a tough but critical task of modernizing those institutions so they can be more public-private and more technology-oriented as they look to the future.
But So what's the secret sauce in making this work? Is it templates for infrastructure building that then needs to be replicated? I keep on being told that actually finance is interested because the returns are there. Has it not been proven, or is capital going elsewhere?
No, I think the secret sauce is blended finance. So you have private financial investors that will seek a certain return, and then you have philanthropies like the Rockefeller Foundation that actually don't need a high return. We want to see the projects happen, and we want to see jobs created, and we want to see our climate protected for our children's future. It's bringing together and convening and partnering across those different types of partners, as opposed to just trying to do everything yourself as a public financier like the World Bank, or as a private financial institution like a global private equity fund. Doing this alone is never going to work. The secret sauce is building unlikely partnerships around concrete and specific projects that have the potential to lift up people and have the potential to save our planet from a disastrous climate future. And you know, we have a few dozen projects that we're doing that at scale already, so we know how to get that done. It's just we need world leaders to come to Paris and force these big institutions to snap out of their way of working and to embrace a much more public-private partnership orientation into the future.
All right, Rajiv Shah, thanks so much for joining us, president there of the Rockefeller Foundation. Coming up, we'll look at the culture of sexism in the City of London following Chris Miody's ousting from his firm. That's next, and this is Bloomberg.
Connection lost.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Fundamentally, we are better when we are not having to navigate our fear of being found out
work, when we have to worry about which pronouns we talk about our other halves in, when we think about our holiday destinations and what you're doing every weekend in June. I don't know, but the point being, I'm reading a book, but anyway, that stuff is unhelpful for you. And when you rip off those shackles, when you don't have to worry about those things, you are 100% delivering.
That is Man Group's incoming Chief Executive Officer, Robin Bruce, speaking at the Bloomberg Power of Action event in London yesterday. Now, in the wake of Crispin Odey's ousting from his firm, we're doing a deeper dive into the culture of sexism in the City of London. Companies have set up harassment courses, whistleblowing hotlines, and tried to diversify, but women say that does not go far enough. Bloomberg's Catherine Griffiths joins us now with the very latest. This is, frankly, a sad story that we shouldn't be writing, Catherine, but you've done a great job in trying to bring to light some of these really shocking cases and what it means about the wider City of London. Like, where are we? If you look at Crispin Odey, what's been happening to Odey, is this symptomatic of a wider problem?
So I think perhaps the Odey situation is a fairly extreme one. Yeah. Of course, Crispin Odey disputes a lot of the things that have been said about him, but I think people might be of the view that there might be something particular about someone who is the founder of a business, such a powerful character. The business is housed in a Mayfair townhouse, which is a small place. When you compare that to sort of big institutions where there are lots more sort of rules and processes that have been put in place, there may well be some differences. But yes, what our reporting shows is that women do feel across the board that there's an awful lot of things that are still going on which they're not happy about, and they don't feel very confident or optimistic that they could do much about it.
What's holding back change? So is it people at the top? Is it, I mean, we went through the Me Too movement, which is that more surprising that we're still seeing cases in the City of London.
Yes, so I think it's a few things that are holding back change. There are things that we know about, like non-disclosure agreements that have been used so much to kind of keep people quiet. There is some sense in which perhaps those are being reduced because actually regulators are sort of pushing back against their improper use. There's the fact that firms and the regulator has whistleblowing processes, but people just really don't feel particularly confident about those. There's the fact that the stats on prosecutions are low, although no one, of course, wants to be in a situation where they're having to bring something like that. But I think more than anything, it's just people around wrongdoers, allowing them to carry on for a long time. And that can be because it's awkward to do something about it. It can be because it's sort of hard to absolutely establish the facts. Or it can be because perhaps one's own self-interest is seen to be allowing them to carry on, whether it's continuing to make profits, continuing to have sort of mutually beneficial, powerful relationships. That's what we see so often.
Catherine, thank you so much. Catherine Griffiths there with some very powerful reporting together with Lucia and Jonathan. We'll push it out, of course, on social media. It's basically entitled Odey's Downfall, shows how far women have to go in the City of London. Now, Bloomberg Surveillance Early Edition continues in the next hour. Pretty Group does in New York. Our Daniel Berger is here in London, and this is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think
I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Global stocks set for their biggest weekly loss since March. Investors stay risk-averse after a string of central bank rate hikes. The latest PMI data adds fuel to those slowdown concerns. Eurozone activity nears contraction, while UK numbers also disappoint. U.S. data are due later today. And President Biden and Prime Minister Modi announced a series of deals to improve military and economic ties between the U.S. and India. The two leaders are also scheduled to meet with corporate executives to discuss tech innovation. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Man, Kriti, that Europe data really adding some fuel to the risk-off fire this morning.
Yeah, and something that's translating straight to the U.S. session as well, Danny. I want to quickly get into futures here because you are seeing that risk-off sentiment that we've kind of seen all week accelerate on Friday. Perhaps a little bit of cashing out ahead of the long weekend. The futures at 44.01 here, down about 0.5%. But take a look at the two-year yield, 4.76. That's that PMI action that you were talking about. Yield dropping about 3 basis points. You're already seeing a little bit of a move there. To me, what's interesting is the Bloomberg Dollar Index. And I should add really quickly before I go there, the 10-year yield moving 6 basis points. So seeing a much bigger move on further out into the curve. The dollar following that story, though, because even though it is stronger by 0.5%, the biggest kind of tailwind for the dollar this morning is the euro. So very sensitive, again, to the economic data that we're getting. NYMEX crude, always important as we talk about those recessionary warnings, Danny. A 68 handle on the commodity there.
Yeah, everything that is high beta is selling off really viciously this morning. The one weird thing I will say, Kriti, European stocks are somehow up. We're up, 0.06%, sure. And what's getting us there are defensive. So it's not necessarily the good type of gains you'd want to see in European stocks. The euro is getting clobbered. This is a really, really painful session for European FX. It is down nearly 1% versus the dollar. We are solidly under 109 this morning. Again, it is that Eurozone PMIs. Valerie Teitel is going to talk to us about them in just a moment. So I won't go into a ton of details. But look, you can see based on what the belly of the curve curve is doing in Germany, the fact that this is where we're buying really does signify that, okay, maybe it's not going to be higher for longer. Maybe the ECB can't be as hawkish as some of them say they want to be and continuing to hike into September. And again, Kriti, just that point that it's anything high beta and anything commodities linked, anything growth linked that's really getting slammed. Look at the NOK. It's down nearly 2% versus the dollar. Remember, this is the central bank that surprised doing 50 basis points yesterday. Not only did it undo all those moves yesterday, all the strengthening, but now it is decisively weaker this morning, Kriti.
Yeah, a massive move, of course, in the FX space, but I gotta say the yield space as well. When you talk about the action stateside, that's really crucial. Of course, you know in the last 24 hours or so, Treasury Secretary Janet Yellen sounding a little bit more optimistic about the chances of the U.S. avoiding a recession. That is good news. But then on the other hand, you have that PMI data out of Europe painting a little bit of a gloomier picture. To break it all down, Bloomberg's Valerie Talitel joins us with the numbers. Valerie, what do we need to know here?
Oh boy, Kriti, services PMIs disappointed across the board. And remember, this is pivotal because services PMI was like the last bastion of growth here in Europe as manufacturing has been weakening for a while. Services held up very well, but cracks in that narrative started showing today. It kicked off with France falling into contraction and then followed with the German numbers also disappointing. And then the Euro area services PMI also disappointing. This is very much aggregating fears of a hard landing here in Europe, and this rebound out of this mild winter recession is now very much questioned. Euro sank on this news, almost 1%, and now the market is getting skeptical if the ECB in fact needs to do those 2 more hikes to get to 4% by September. We also had the UK PMIs. They weren't as disappointing, but still disappointing nonetheless. Services also contracting, or sorry, also falling versus consensus, still in expansionary territory. Manufacturing was slightly weak as well.
Man, I mean, the recession and vibes are very vibey in Europe, but in the U.S., we have Janet Yellen saying we're not going to get a recession. Are things that different in the U.S. than Europe right now?
Things are still looking more rosy in the U.S., really putting so much pressure on the fact that it's the U.S. economy who still seems to be the bright light holding up well to all these interest rate hikes. We do get the services PMI and the manufacturing PMI later this morning, both expected to fall slightly versus last month's print, but not as much, and we're still nowhere near contraction territory when it comes to the services PMI in Europe. It's expected to come at 54.
Valerie, thank you very much. That is Bloomberg's Valerie Talitel. Now, elsewhere in the U.S., moves from regulators to raise capital requirements for lenders will fall largely at the feet of Wall Street's biggest banks. Fed Chair Jerome Powell told the Senate Banking Committee lenders that lenders rather could face an increase of around 20% in what they have to set aside.
The capital requirements will be very, very skewed to the 8 largest banks, the G-SIBs. There may be some capital increases for the other banks, and there won't. I think none of this should affect banks under 100 billion.
Let's bring in Bloomberg's Tom Metcalf on this. Tom, when could these changes take effect?
Yeah, I mean, look, they're looking to come through these Basel III changes at the start of 2025. So there's a fair bit of time for the banks to sort of obviously prepare for them, as is always the case here. But, you know, the size of this increase, 20% is absolutely massive, obviously. And you've already had a few of those big bank CEOs like Jane Fraser of Citigroup saying this will be a, huge change. And, is it the right sort of quantum?
Tom, talk to us a little bit about the Citi story here. We're getting a lot of different kind of headlines, and you just referenced it yourself. Walk us through what we need to know on Citi.
Yeah, well, so as well as obviously, Citi being one of the banks to be affected by big capital requirements, we had a great scoop out yesterday about how that bank has taken, more steps to try and encourage return to the office. So traditionally, last few years, it's been a little bit more lenient than some of the other Wall Street banks. But now we understand, they're starting to really track their employees' sort of attendance and looking to kind of, have those conversations, between managers and direct reports in terms of you really need to start coming back in or there will be more consequences.
Yeah, a lot to digest from the Wall Street world. We're going from Wall Street to geopolitics in just a moment. Tom Metcalf, thank you as always for breaking that down. A crucial story, again, as we talk about the read-through into what we're going to hear in Washington, which brings us, by the way, to the geopolitics. Prime Minister Modi had his first visit to the United States yesterday, where he and President Biden announced a series of defense and commercial deals designed to improve military and economic ties between their nations.
With this visit, Indian firms are announcing more than $2 billion in new investments in manufacturing, solar in Colorado, steel in Ohio, and optic fiber in South Carolina, and much more. Further proof that America's manufacturing is back.
We bring in Bloomberg's Roz Matheson for a little bit more of a breakdown. Roz, 24 hours ago, we had Prime Minister Modi really already talking to a lot of the tech CEOs. How does that materialize? Where do we go from here?
Well, certainly we have seen him come on this visit and scoop up a bunch of deals, really, for Indian companies, both in the defense space and the tech space. We've got deals for big companies to do jet engines, to do drones, and also in the tech space with potentially more to come. We've got Elon Musk looking around to invest in India. We've got that potential $1 billion Micron investment in India, and that's really as India's trying to set itself up as a place to do business in the tech space, an alternative, of course, to China and elsewhere in Europe. So really a lot of deals on the plate. We can see he met at that dinner last night a bunch of big CEOs from big tech companies in the US, Apple, Alphabet, Microsoft. They were all there last night. He's meeting further with further business leaders today before he leaves the US, so possibly some more deals to come. But certainly we can see the effort there to sort of do a lot more business between the US and India, and it's got that strategic element too, of course, of drawing India closer to the US and further away from China and Russia.
Roz, now elsewhere in D.C., Biden was under some heat about comments he made about Xi using the word dictator. Let's just take a quick listen to some of what he had to say about that.
We had an incident that caused some confusion, you might say. But the Secretary Blinken had a great trip to China. I expect to be meeting with President Xi sometime in the future, in the near term, and I don't think it's had any real consequence.
So Biden there saying he doesn't think it's had any consequences. How would we know if it has? Are there any signs?
Well, there are several things to look for, but obviously the US is trying to send a signal that perhaps the US president, this is an off-the-cuff remark, this was not meant to be made at the time, move beyond that and back to the idea that they're trying to reset ties more broadly, look at the visit from Blinken and so on, and so a real effort to sort of say, let's not have this become a true problem, despite the China anger over it. There are several things to look for. We have the Chinese premier in Paris. He may meet today briefly with the US Treasury Secretary Janet Yellen. A handshake, even something, would be a signal, and possibly looking at a visit to the US pretty soon from the Chinese foreign minister, and that would be another sign that at least these level of meetings and activities are going on, all trying to build towards that meeting between the two presidents later this year.
Okay, Roz, thank you so much for that. That is Bloomberg's Roz Matheson. Now, coming up on the program, we're going to be speaking to Sushil Wadhwani, PGIM Wadhwani CIO and former Bank of England MPC member. Plenty to discuss there, and plenty to discuss in the world of stocks. We're going to be speaking as well to Neil Brown, head of equities at GIB Asset Management. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. they're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, we are wrapping up a pretty tumultuous week when it comes to the S&P 500. We've seen a lot of rate hikes around the world, then coupled with a little bit of economic data and commentary from government officials. It's the same issues, inflation, recession, but this time, perhaps the S&P 500 taking a little bit of a breather. For radio audience, stick with me. For our TV audience, we are looking at a chart here, just putting those percentage gains or losses into a little bit of perspective. This week saw so much red on the screen that is actually the worst week, going all the way back to the week of March 10th. And that is significant because that week, I'm sure you guys all have it marked in your calendar, was when we all saw that massive banking turmoil, the risk-off idea that liquidity was an issue, that the banking system and broadly the markets were going to take a bigger tumble. Of course, we know that in the following weeks, as that situation cleared up, we did see a little bit of buy-in. But since then, this kind of makes sense, seeing a little bit of a pullback after about 5 weeks of gains. Let's bring in a little bit more markets analysis here. Phil Serafino, our Bloomberg Markets editor, joins us from Paris, I believe. How much of this is just some sort of technical pullback, given we have seen a lot of green on the screen for the last month or so?
Yeah, I mean, that's true. You might expect a little pullback given how strong the market's been. But you also get a sense from talking to investors that the narrative is kind of shifting this week. I mean, up through last week, the sentiment had been, everything was going to be just right. The Fed was going to engineer a soft landing. China's going to pick up because they're going to provide some stimulus, and everything would be fine. We'd avoid a major recession. This week, there's been a lot of rethinking of that narrative. We saw more profit warnings from some chemical companies, which are a really good sort of bellwether for the industrial economy. Lanxess, the big German company, put out a profit warning this week. I think that was the 5th one from a big European chemical company. So that sort of tells you there is some question about the strength of the economy. The Fed has continued to make hawkish noises. Powell is sending the message that, it does not seem like they are going to be cutting rates anytime soon. They have farther to go on the increases. And so you do get the sense that the narrative is shifting. And you can see it in the leadership in the market. You look what's not doing well this week. Biggest losers, real estate, energy, financials, basic materials. That's an economic indicator.
Didn't home builders, though, Phil, just hit a new high for the year, though, this week? I still feel like there's some confusing cross-currents here.
Absolutely. And that one, I think, has a lot of people scratching their heads. How can it be that the economy is heading into a recession if home builders are going to all-time highs? I guess that's what makes markets interesting. You weigh that against the question of industrials not doing well, the message from the Fed, commercial real estate just getting absolutely pounded. Here in Europe, we've got some major problems in places like the UK and Sweden. So yeah, cross currents, I guess, is the best way to put it. But it really does make you wonder.
Well, Phil, let's marry those two ideas then. Are you hearing any sort of optimism around saying, look, it's time now to hop into the cyclical trade again, or is this kind of a one-off?
I have not heard anyone say that. I think, as I was saying earlier about the chemicals, that is sort of a cyclical bellwether that tells you there is further downside to go. Like I said, we've seen 4 or 5 big profit warnings. I think maybe the time you want to buy those is when things are at their absolute worst and in the economy, because that would be the bottom, and it feels like we haven't gotten there yet.
I love that Bank of America just put out a new note about some of the rotation, that tech funds have seen $2 billion worth of outflow this week through Wednesday, saying that we're fleeing the baby bubble. Phil, though, I got to wonder, if we're heading towards a worse time for the economy, I mean, tech is a little bit less cyclical, no? So I feel like maybe we might see some folks go back to that.
I mean, that's the eternal debate. When there's very little growth in the economy, some of these companies that have secular growth stories, like a lot of these tech companies, they should hold up okay. But again, there is a pretty fierce debate about how well those companies will hold up in a down economy, and which ones within tech. There certainly will be some winners or losers, but for now, at least, I think investors are backing off a little bit, given the cross currents we were just talking about.
Phil, as we speak, our producer Dan Curtis talking about how Apple closed at a record high yesterday. We're getting really close to that $3 trillion mark. One of my favorite fun facts about Apple stories, every time it hits the $1 trillion, the $2 trillion mark, not only does it have a massive sell-off, it takes the entire S&P 500 with it. I wonder, in terms of positioning, is the market, are equity investors positioned for some sort of bigger sell-off?
I think if you saw a big sell-off in something like Apple, I mean, just because of the sheer size, that would drag the index down, and it would probably be a sentiment indicator for, especially for retail traders. You know, Apple is just a beloved stock in the retail world and institutional as well. That would probably would not be a good signal. But I also have to say, Apple is a marketing powerhouse and seems like one of those brands, at least from talking to investors, people think they would hold up relatively well in a down cycle. So that remains to be seen. But yeah, the $3 trillion milestone will be something to watch.
So we can buy Apple, we can buy the dollar, maybe the two only safe places in this market right now. Phil, thank you so much for joining us after a tumultuous week. Bloomberg's Phil Serafino there. And for more market analysis, go to MLiveGo on your terminal. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now, let's go to some of the stories that caught our eye this morning, and the one that everybody has been paying attention to all week. The U.S. Navy had already detected an implosion of the Titan submersible on Sunday. That's according to a senior Navy official. The information was shared immediately with the U.S. Coast Guard, and search teams were dispatched to, quote, make every effort to save the lives on board. The Coast Guard announced Thursday that they believe the 5 passengers on board died from an implosion. All right, let's shift gears a little bit and now look at some of the corporate stories we've been tracking. Over in Europe, a big sell-off. Shares of Siemens Energy fell to a record low amid deepening concerns over its wind unit. The unit's Spanish division found worse than expected quality flaws at its wind turbine. Siemens withdrew its profit guidance, warning of additional costs exceeding $1 billion. Kriti, this specific unit, this wind turbine unit for Siemens, I gotta say, it continues to be a headache for this company. I interview the CEO at Siemens Energy quite frequently. I'm pretty sure every single quarter over the past 2 years, I've asked him about the wind turbines because it is an issue for them.
Yeah, a turnaround plan that isn't necessarily working out for it. I have to say, though, it's kind of a little bit of deja vu, Danny, because it's a new issue, perhaps, but it's almost the same problem, the same thing we're talking about. It comes down to raw materials, to commodities, to the supply chain, the idea that the rising costs that you're seeing in things like steel, for example, still having a really adverse effect on some of that production.
No, it's absolutely true. I mean, you do have this kind of irony that it is this green shift. People want this type of energy. They want turbines, but that kind of exacerbates what you're talking about, right? A lot of demand, but not much supply. Okay, other demand-supply dynamics, especially in labor. Ford, Kriti, you flagged this story to me. They're planning a fresh round of layoffs for U.S. salaried workers. That's according to the Wall Street Journal. The job cuts are expected in the coming weeks in its gas engine business. Kriti, I feel like you're trying to make me sad because not only did you flag this job story to me, you also flagged, what was it, FedEx earlier this week, also cutting jobs?
Well, it's interesting. I admittedly am a little obsessed with the labor market right now, finally getting on that train a year after everyone else hopped on it. But what's interesting to me is the way it's showing up in the stock market, because even though from a kind of human perspective, it is sad, of course, to lose a job, and it's very hard on families at the moment. From a stock market perspective, shares are often rewarded for it. We just saw the Ford shares higher by 1.2% on those headlines, at least yesterday. The pre-market down about 0.6%. What's important to keep in mind here is that if this was a tech company, you'd be seeing the share reaction in the opposite direction. But for a company like Ford, industrials, car makers, that doesn't seem to be the issue. And especially when Ford is saying this is yet another layoff. They've announced several in just the last year.
Are we finally going to start to see that show up in the macro data? We had initial jobless claims yesterday. They did surprise to the upside, a new high of 264,000. The 4-week average ticks higher too. Perhaps we're starting to see some cooling in the labor market, Kriti. Maybe this is finally coming and will help out Jay Powell and company.
I mean, you would hope so, right? But then there's always those lags, right? You have the warn notices, then you have the way it actually feeds into the data, then like the lag in terms of actually reporting the data, and then the market saying, oh, hey, look, there's a trend. So it'll still take some time for it to actually show up, but we're getting there. We're seeing them on a bigger scale now.
Yep, something that Powell mentioned in his congressional testimony. All right, coming up, we're going to be speaking to Sushil Wadhwani. He is a former MPC member, advisor to Jeremy Hunt's Economic Advisory Council, and current hedge fund manager at PGIM Wadhwani. He is the CIO and founder. We're going to be speaking to him about the shocking BOE decision yesterday. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Global stocks set for their biggest weekly loss since March. Investors stay risk-averse after a string of central bank rate hikes. The latest PMI data adds fuel to slow down concerns. Eurozone activity nears contraction, while numbers in the UK also disappoint. U.S. data are also due later today. And President Biden and Prime Minister Modi announced a series of deals to improve military and economic ties between the United States and India. The two leaders are also scheduled to meet with corporate executives to discuss tech innovation. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest on the geopolitical front and the markets front, but I got to say, the bond market still taking the cake.
I mean, it is a high beta sell-off. It is a run to safety. Whatever side of the coin you want to look at, it's happening this morning. It was, for the most of the week, maybe just looking like some consolidation, but it's looking worse now. As you say, the bond market, we are buying bonds. We're buying the belly of the curve, specifically 5-year in Germany. Those yields are lower by 14 basis points. Perhaps it makes sense that the action is concentrated around the belly, because if the data is looking bad, we had Eurozone PMIs come in so close to contraction, a huge disappointment in France and Germany and the overall data. Perhaps we're not going to be higher for longer. Perhaps we can't have the ECB hiking again in September. So again, it makes sense. It's the belly where we're starting to see some of this buying. But again, if anything is high beta, it is selling today. Okay, maybe except for stocks. Now we're at the dreaded unch for European equities. Those are unchanged. Again, a bit of a head scratcher. I don't understand why European stocks aren't selling off. Look at the NOK, though. The dollar versus the NOK is gaining nearly 2%. And this is a central bank that hiked by 50 basis points yesterday. But it is getting clobbered, as is the Aussie dollar. So again, those commodity currencies. And again, because the Eurozone data was so bad, it is a lot of euro weakness in dollar strength. It's kind of the dollar, the U.S. economy being the least dirty shirt right now, Kriti.
Yeah, certainly something that you're going to see have a ripple effect into the U.S. right now, starting with the economic data that you just outlined in Europe. I'm going to skip over the futures. We'll come back to that in a second, but the two-year yield is what's catching my eye. The 475 level, again, we've been pricing a much more hawkish Federal Reserve, so that two-year yield has been inching higher and higher to that 5% level. Today, it's down about 3 basis points. Again, coming back on those recessionary concerns. If you look further out into the curve on the 10-year, for example, you're seeing a much bigger move. So again, volatility already baked into this morning's trading session. The dollar, as you mentioned, the strength, off strength, really coming off of the European currencies. Again, the euro weakness that you just outlined, as well as this commodity currencies, giving the dollar a little bit of strength, even though, by the way, we have had news out of the Federal Reserve and out of course, the geopolitical situation that maybe the U.S. is potentially in trouble too. Janet Yellen, on the other hand, saying, look, maybe we're a little bit more optimistic. It won't be that bad here, but who knows? I'm going to come back to futures here, down about 0.5%, 4,400 on that level. Danny, I imagine this is just kind of a cash off take, pulling back from 5 weeks of gains. It's a Friday. It kind of makes sense. It's rainy outside. That happens in the New York session. So down about 0.5% this morning. But again, sticking with that theme of gloom, you're seeing the same story in crude. So again, the risk-off sentiment in both commodities and futures are on the same page. About a 68 handle there, down just shy of 2%.
Yeah, it's really kind of interesting to assess why are we so gloomy on the economy. Is it some of the PMIs? Is it the data? Is it the BOE yesterday? And on that point, the latest UK PMI data did come in lower than expected today. Retail sales, they unexpectedly rose in May amid some of those mounting inflation fears. And of course, all of this followed a surprise from the BOE, hiking 50 basis points, raising its rate to the highest level in 15 years. Let's get to someone who knows monetary policy extremely well. It is Sushil Wadhwani, CIO of PGIM Wadhwani and former Bank of England MPC member. Sushil, so great to have you on the program. Thanks so much for joining us. Look, markets after that decision yesterday are pricing something like a 6.1% terminal rate for the BOE. Is that where we need to go?
Good morning, Danny. It's a great pleasure to be with you. I interpret the bank's decision yesterday very much in a stitch in time saves nine type philosophy. They were very anxious to show that they could occasionally be hawkish, and that and the message that accompanied this hike was very simple. It was that they're now going to do whatever it takes to ensure that inflation gets back to target. Now, as to whether or not they'll need 6% terminal rate is still very much an open question. Remember, there are two narratives playing out in the UK. One possibility is that inflation has genuinely become embedded into wage and price setting, higher inflation expectations. And if that is true, then you could easily get to 6.1%. The other narrative is that the surprising data that we've seen in the last 3 or 4 months, where inflation has come in higher than expected, is just merely a matter of delays. We've seen producer price indices ease meaningfully, and at some point that should come through into consumer prices. And maybe that hasn't happened essentially, just because of unpredictable timelines. If it turns out that the data, the inflation data starts now surprising on the downside in the next 2 or 3 months, then we're not getting anywhere near 6.1%. I think
so Sushil, we need to wait perhaps in that case, but in the meantime, we were just showing a screen of some of the papers in the UK, some of their editorial sections this morning. I gotta say, it is pretty brutal. You have the Daily Mail calling Andrew Bailey the bumbling governor failing Britain, the Telegraph saying people will be hurt by Bank of England's chest-thumping blunder, the FT saying the Bank of England's credibility is still on the line. Sushil, does the BOE, does Andrew Bailey have a credibility issue right now?
So I think the one thing I've learned over the years is that the British media can occasionally overreact, and sometimes one should learn to sort of fade that noise and focus on the underlying fundamentals. Whatever has happened is now water under the bridge. We need to look ahead. The good thing is that the bank is on the case. They've emphasized that they are now going to do whatever it takes to bring inflation down. And what we now need to do is to be patient and essentially ensure that we get inflation back to target.
So is the right trade-off then, if necessary, Sushil? Should we see a BOE that needs to engineer a recession in order to make sure inflation isn't entrenched?
So, as I was saying earlier, it really depends on which narrative about inflation surprises that you believe more. If you believe the delay hypothesis, i.e. the one where inflation is likely to come down anyway, then a recession is going to prove to be completely unnecessary. If, on the other hand, it is indeed the case that higher inflation expectations have become embedded within the inflation process, then sadly we know that you need to work extremely hard to essentially change the inflation process and bring inflation expectations down. That tends to be a very painful experience, and then sadly a recession may well occur under that scenario. I think we truly don't know, and it's very, very important not to overreact to recent developments in terms of trying to determine whether or not a recession will be necessary.
Yeah, tell that to a day trader. Sushil, talk to us a little bit about the fiscal side of this equation. We know that a lot of the folks are looking at this inflation saying, look, this has been an issue in the UK for decades, structurally speaking. When we're talking about perhaps the blunt tools at the disposal of the BOE, how much can the fiscal side really help?
So, I mean, it's obviously very important that fiscal and monetary policy point in the same direction. You'll recall that we did see fiscal tightening last November, and I was very reassured by the Chancellor's letter to the Governor yesterday, where he restated the need for budgetary discipline.
What does that then mean?
Sorry.
I was going to say, what does that then mean in terms of the actual, say, human impact, the cost of living crisis, for example? I've been reading a lot about just how much money it takes to live in London right now, for example. Compare that to some of the inflationary pressures you're seeing around the world in the rest of Europe and in the United States as well. Put into perspective for our global audience and for an American audience just how sticky that kind of inflation is.
So, I mean, certainly inflation has proved to be stickier than most of us would have hoped for. And I think the proximate causes of that were probably the fact that our labor supply shrank more than in many other OECD countries. And the second reason is obviously related to Brexit, where what Brexit has done in addition to reducing labor supply is that you've seen much less corporate investment in recent years, which means the productive capacity of the economy shrunk. And obviously, it's also had an impact on import prices, which have been higher than they would have otherwise been because of non-tariff barriers. And if you put all that together, I think you begin to understand why inflation in the UK has been stickier than elsewhere, which is why the bank arguably has to work harder than it might have had to do in different circumstances.
Right. Sushil, we got some PMI data in from Europe, from Germany, from France. It was weaker than expected. It was contractionary in a lot of different areas. And we have a market now that is trading something that looks like recession. Is that a trade you would want to follow, that the European economy is headed towards recession?
So if a recession happens sort of later in 23 or in 24 in the US, the Eurozone, and the UK, this will be the sort of most advertised recession, at least in my professional lifetime. Client perceptions of the possibility of a recession have been high for a considerable period. It may well occur. I'm still in the camp of believing that a recession in the US over the next 6 to 18 months is more likely than not. But I have to confess that I've learned to be more humble about this prediction, essentially because the pandemic has changed a lot of the economic relationships we usually rely upon. What I've been impressed by in the US is how much wage growth has come down without unemployment moving much. And also other measures of labor tightness, like the vacancy unemployment ratio, are well off their peaks, again, without unemployment having moved much. So I think it's important to be humble. You were asking me about the Eurozone, and I didn't mean to deflect your question, but I think the same mechanisms apply there in terms of what's been going on in the labor markets.
Right. Sushil, I love that. I mean, right, because so many people have gotten so many calls wrong. No one is really immune to having misinterpreted where this economy was going post-COVID. Sushil, thank you so much for joining Kriti and me this morning. Sushil Wadhwani, their CIO of PGIM Wadhwani. Now coming up, Neil Brown, head of equities at GIB Asset Management, joins us next. Does he want to make the recession trade? This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Global stocks headed for their biggest weekly decline in more than 3 months as the latest data add fuel to recession woes. Joining us now is Neil Brown, head of equities at GIB Asset Management. Neil, thank you for joining us this morning. This pullback that we're seeing in equities around the world, how much of this is just technicals, the stock market taking a little bit of a breather, as opposed to a real fundamental worry?
Good morning, and thank you for having me on. Listen, I think we need to put this in the context of the rally we've had, of how much markets have moved, particularly certain parts of the market have moved into these kind of prints. We are obviously, we've had a long run. I think the data this morning, particularly the PMI, it is still expansionary. It's clearly a disappointment, and France is below 50, but I think we are still expansionary. I think we still forecast through the near term decent growth this year. 2.8 this year globally, 3% next. So I think we see fragile growth. I think we need to be cautious about the risk of recession. And if you look at the rally that we've had, there have been pretty significant swings on the way up to 14, 15%. And I think we might just be, this is fragile. This is a very narrow rally. And I think we should expect these kind of pullbacks as risk looks a little more dangerous.
Neil, I often joke with Danny that, given that she's a fellow American, that Europeans are never bullish on the stock market, especially when it comes to American stocks. Neil, what is it going to take you to turn bullish?
So we are pretty bullish, I have to say. I think the market overall, we have reset. We're at 17 times forward earnings. We're up 14, 15%. We know the Nasdaq's up significantly more than that, and growth is clearly led. But it really is narrow. It's 5 stocks doing the lion's share of the work. So what makes us bullish here is seeing that broaden out, seeing there's only about 30% of stocks ahead of the benchmark. That's the lowest since 1991. So we would want to see broaden out into those resilient growth names, see some confidence, understand, have some faith in what the Fed is doing. They are going to hold rates higher for longer, but see and start to reward those pockets of resilient, high-quality growth where they're there.
Well, Neil, can I push back on that for a very quick second? When the conversation of breadth really comes to play, some people are making the argument that this is the one time that's the exception to the rule because there's so much fundamental money, investment money, going into this AI race that has then fueled the chip rally, the big tech rally. Is this the exception to the rule? Could that argument be made?
Yeah, I think, we have to acknowledge 5 names doing all of the work that we do have. I don't want to say the word boom because it usually comes along with another word quite quickly, but this is clearly a strong move for AI. This is clearly, it's an interesting time, right? It's still the picks and shovels. It's still the investment in the training. It's not the inference. It's not the diggers, if you like, from the picks and shovels. So we do need it to broaden out into software names. We do need to see these tools being used in the real world economy. And that's why I think we get these swings. But we do think it can broaden out. We do think there's really strong, resilient growth. We use secular and structural themes to find them. We have a lot of really powerful themes that can run through cycle, and we think that's where it broadens out into.
This week, looking at some of those AI names that are kind of if you squint really hard, you can call it AI. Some of those actually did sell off. There are a few in Asia. There's one in the US, Symbotic. It fell 8% yesterday, 9% the day before. Have you been tracking of any of these? Is this kind of a good sign if some of these type of names are coming back to reality?
I don't think it hurts. You can't have it all one way, and we're seeing that today, right? It doesn't hurt if you get a little bit of sense into the market. I think you're seeing a great deal more skepticism about just the phrase AI. People are really digging in. What do you mean by that? Where are you in the space? Where are you taking value? We focus on as I say, the picks and shovels, NVIDIA's, ASML's, those that are at this stage, and showing, a lot of this was a bit of hope at the beginning, but we've seen good numbers. We've seen $4 billion in data center from NVIDIA. There is numbers behind this. Obviously, we got a big outlook and a lot of hope, but we are starting to see actual revenues from these.
I would love to know how you trade NVIDIA. So did you hold it before the rally? And if so, could you keep holding it? Did it set off triggers like this is becoming too much of my portfolio because of how much of it is rally? Have you added to it?
So we did hold it. We've held it since we launched this fund, so a couple of years now, and we have trimmed on the way up. We actually had to trim last year because of the duration and the growth and just the risk that it was carrying. And then you get when something goes up this much, obviously it becomes a big part of the portfolio. And that is also, I think, what you're going to see. That's part of the broadening out story, is people taking profits in these very successful names and saying, okay, that's a big part of the portfolio. Where can I start to look at getting the risk elsewhere?
Okay, so if that becomes too big, you want to look elsewhere. Where specifically do you want to go?
So we still like ASML. That's another stock that I've owned in various incarnations for more than a decade. A fantastic business, poured a lot of money into trying to solve the miniaturization of chips. There's 30% CAGR in lithography equipment. They've got extreme ultraviolet. These machines are selling for $180 million. They've got the next ones out at $380 million.
What about the China risk, though?
There is a very clear China risk, and that is something we're monitoring day by day, as are the company. We think they'll do okay. They've done quite well at shipping out some of the lower technology, still very good technology solutions. But yeah, they'll have to navigate that. I think they've been very clear on their position, but they'll need to navigate that.
Hey, Neil, thanks so much for stopping by the studio on this Friday. Enjoy the rest of your Friday and your weekend.
Thank you.
That is Neil Brown, Head of Equities at GIB Asset Management. Now, coming up, we're going to talk about the market-moving events that you need to watch out for today on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London with Kriti Gupta in New York. Let's take a look at what's ahead today. ECB's Fabio Panetta will be speaking at 8:45 a.m. Eastern Time. And we're going to get U.S. PMI data at 9:45 a.m. President Biden and Prime Minister Modi meeting with corporate executives. That will happen at 11:45. Finally, we're going to get some Fed speak. We're going to be hearing from Cleveland Fed President Loretta Mester at 1:40 p.m. So that is the diary for today, Kriti.
Yeah, a lot to watch for on the macro front, and of course, a lot coming up next week as well. I want to get to some of the stocks we're watching in the pre-market, get to the micro front here. One of the big names is 3M. The ticker for our radio audience is MMM, higher by about 3.3%. They are paying $10 billion to settle their PFAS water pollution suits. Essentially, these are the so-called forever chemicals. It's manufactured for decades. The accusation here was that they polluted drinking water supplies across the United States. Now, the reason the stock is higher is one, because this amount was previously reported and expected. The second piece of the equation is that it is a smaller amount than a lot of analysts had really kind of put away for. So good news there from an investor point of view for 3M. I almost want to get to Ford here because you are seeing some layoffs in the works, down about 0.6% in those shares, preparing another round, this time to U.S. salaried workers in their gas engine division. This comes after several other rounds before. They're really taking cost efficiency into high gear. So not necessarily a positive for that stock or that company. Danny, I'm going to end very quickly on CarMax earnings. They are reporting after the close. We know that used vehicles have been a key source of inflation, but now it looks like perhaps they're still going to have that revenue read through into CarMax, higher by 1.2% this morning.
Yay, we can finally maybe afford used cars. Wouldn't that be nice? I can barely even buy a flat or apartment in New York, let alone a car. So hopefully that'll change. All right, that's it for early edition. More surveillance is ahead. This is Bloomberg.
news.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power. Every weekday at 5 p.m. Eastern. Only on Bloomberg. Your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
The economy is just not as interest rate sensitive today as it has been in the past.
When the Federal Reserve says 50 basis points, the market's saying unlikely.
It's going to take a while for a central bank that has avoided raising interest rates to gain the credibility of the market.
Monetary tightening will trigger recessions in a number of different countries. I think a soft landing is very difficult.
The bond market is just screaming that tougher times lie ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A Friday into the weekend, into the third quarter of this year, and into a full-length 3-hour recession chat. We're on the Recession Watch today. John Farrow on assignment, Lisa Abramowitz, and Tom Keene with you. Wow, have things changed in 24 hours? Recession signals abound.
This has been a massive narrative shift, and we saw it slowly and then all at once, and that was what this week really marked. We saw initially the sense of resilience that markets could keep rallying despite all the rate hikes from around the world. Suddenly, a reset, people expecting the central banks around the world to create pain that's going to mean a downturn.
For those of you on radio, I hereby call it Guess the Recession Friday, because that's clearly what we're seeing. We see it on the screen. We've got a great set of guests to start your weekend conversation. Adam Posen will join us later. Richard Haas will join us later. And we're going to start strong with Greg Bottle of BNP Paribas here in a moment. Lisa, let's just go through the tea leaves out there. Can we start with oil? Well under $70 a barrel, $68.75. It says, guess the recession.
Well, and we've been playing that game with the yield curve, which also is the most inverted in the U.S., or nearly so. Going back to 1981, the German yield curve, the most inverted right now, going back to 1992.
Wow.
Looking at all of these signals of recession that have been there, people were just able to ignore them and say AI, AI, AI. And now suddenly people are saying, maybe that's a little over its skis. And even that can't save us from central banks that are determined to raise rates beyond what people expected.
The VIX yesterday confounded everyone. It's like a day to have Dean Kernan on for 3 hours. We'll try to work on that for Monday, Tuesday of next week. Yesterday, the VIX gave us a no volatility bull market, 12.73. I don't know what to make of it.
Well, Morgan Stanley analysts wrote a whole piece on this, talking about how there have been distortions in some of these main indicators of volatility due to some of the positioning out there. Does this mean there is less volatility, or does this mean it's being expressed in other places that are kind of coming to the fore? Again, people aren't gloomy. It's just the narrative has shifted to no landing to a landing.
I think the publishing this weekend is going to be fascinating to see how people reset off Switzerland moving, Norway moving, the shock of the United Kingdom yesterday and on. Let's do this. Let's do a data check. Get right to it. At least got a brief in seconds. Futures are giving me a little bit of a negative feel here on a soggy week, to say the least. Still, S&P 500 futures right now, 4403. I feel like they should be a lower statistic, but they're not. The VIX, 13.36. Two-year yield, 4.76%. I mentioned oil. Brent crude, 73.50. Can you imagine a $69 Brent crude price? What would that mean for Riyadh? In the currency space, slightly stronger dollar off the weakness of 2 days. Euro 110, print now 108.63.
And just to sort of lean into the euro story for a minute, we did get those disappointing PMIs overnight. And just to sort of put this in perspective, European equities have seen their longest streak of losses going back to December. Global stocks just saw their biggest weekly loss going back 3 months. We are seeing a shift that's not just central bankers talking about further rate hikes.
We're going to have to see. I mean, it's as simple as that. I like Abramo out on Twitter with an important quote. This from Torsten Slok. The only way to get inflation down to 2% is to crush demand.
Well, the concern...
That sounds like it's very Bramo.
Well, it's the consumer.
Let's crush demand this
weekend.
weekend.
The consumer. We'll get some more discussion from those Fed officials that have been crushing the potential optimism of a no landing. Fed speak includes Atlanta Fed's Raphael Bostic at 7:30 a.m.
Right?
He has been dovish. He has been saying, let's hold rates where they are, and they will inflict more pain as the year goes on. 7:30 a.m. will be that speech. 1:40 p.m. Cleveland Fed President Loretta Mester, perhaps taking a more tempered approach. 9:45 a.m. This is really going to be potentially the key data point, especially after what we got in Europe. U.S. S&P Global U.S. Manufacturing and Services PMI for June. It was pretty ugly over in Europe, particularly in France, where now people are projecting some sort of recession because services PMIs are rolling over, and this is not what people want to see. This, to me, is one of the key moments to watch in the U.S. And today and tomorrow on the political front, the Republican Faith and Freedom Coalition Conference kicks off in Washington, D.C.
I missed this event, please.
And then we get a sense of all of the different 2024 presidential aspirational presidents. The former President Donald Trump among them will be at the event. We hear ex-Vice President Mike Pence, awkward, Vivek Ramaswamy, Asa Hutchinson, U.S. Senator Tim Scott, Chris Christie, and Ron DeSantis are among those.
Guys, for those of you on radio missing the pageantry here, it looks like Hollywood Squares.
Kind of feels that way, too.
I mean, I'm looking for Nipsey Russell to run here at any point. Let us get started now, and we're going to really focus on the debate and the conversation over guess the recession. We've been wrong for 18 months on a recession as a collective society, and it's really front and center here on Friday. Joining us, Greg Bowdle, U.S. Head of Equity Derivative Strategy at BNP Paribas, with some serious computer science study at Liverpool long ago and far away. You a bull or a bear in this milieu?
I'm a bear. We've been a bear for the market all year. We think that these kind of recessionary headwinds are going to catch up with us. But really, it's been positioning that's been the driver for the markets over the last 4 to 6 weeks. And we see some signs of that exuberance in the market starting to fade.
Why is there a bid in stocks? I mean, it's just as simple as this. There's a camp out there like you. You're really worried about left tail risk. You're hedging the optimistic right tail risk. Great. You've been wrong. Why is the market going up?
Yeah, the view that there is potentially going to be a recession has been the consensus call, and you can really see it reflected in positioning. I think one of the clearest indicators is looking at the CFTC data, where you can track the futures positioning, and you can see that by client type or investor type. The levered funds, which is essentially hedge funds, have a short position, greater than 150 billion. It's about 3.5 standard deviations above the 5-year mean. So the pain trade for markets has been higher. And we really saw that when the market broke through 4,200, we really saw this morph into a kind of an exuberant squeeze higher. And that's been coupled not just by a short squeeze, but also by people coming back into the market in a more speculative manner. You can see things like some of the retail sentiment indicators, AA, II, bull indicator, and it's very much tracking the core volumes that we have also seen explode.
It feels like when you come home to one of your family members and they've been in a pretty good mood, and then all of a sudden you just feel the pall of a bad mood kind of setting in.
Something you'd like to discuss here, Greg? Hold on.
Hold on a second. No, just let me.
Friday therapy with Bramwell.
No, it feels like that a little bit walking in today with the markets. there's sort of a pall of a bad mood that seems to have settled in. It wasn't just 1 day, 2 days. This is something that's going to be longer lasting. Do you believe that this has legs, or do you think that this is going to be something that's shorter?
Straight face.
I think the medium-term view is that we get the recession, and that can drive a deeper drawdown. I think in terms of the next week, I think we have some large technical selling flow that's coming up into month-end and quarter-end, and that could see this move that we've seen this week accelerate into next week. If that is to continue into the next month, then I think it really comes back to the fundamentals. So one, monetary policy, what the Fed are going to do in July, and two, earnings season that also kicks off around the same time, mid-July.
Is the sell-off going to be concentrated, in your view, in the consumer discretionaries at a time when Janet Yellen is saying that there needs to be a slowdown in consumer spending to really effectuate some sort of decline in inflation? Or do you think that it's going to be in the high flyers, in the tech stocks that have led the way up?
So I think we might have different layers of what is driving the sell-off. I think if what we're talking about is the potential for the Fed to hike at the next meeting, tightening liquidity, then I think what you can have is a reversal of some of the high flyers and some of the more egregiously valued stocks. Ultimately, the narrative this morning is more about a slowdown. If we do have a recession later this year, then I think it morphs into a much broader-based sell-off.
This feels like a slow-moving freight train, right? Because right now we haven't shifted to Armageddon. We haven't shifted to, oh my goodness, it's going to be a deep recession. We've shifted to 3 to 5% pullback. At least that's Michael Hartnett over at Bank of America. Maybe a bit of a reset. Maybe wait for buy the dip. Is that the kind of feel that you get as well?
In the very short term, yes. So I spoke about the month-end and quarter-end selling flows. When we see that type of flow, it tends to manifest in a shallow sell-off. What the options market is certainly implying is not that we are going to get some kind of ferocious moves in the short term. I think ultimately, if we get a recession, though, in Q3, that's a move that could be much more violent and much deeper.
Away from your derivative abilities, is there any optimism that corporations can adapt to a widely anticipated recession?
I think so. I think that obviously the secular theme of AI has been much talked about. At the moment, it's a very narrow CapEx-driven theme, but that's a tailwind for the market. I also think when we just look at corporate earnings revisions, the story in the back end or the second half of last year was one of quite a large downgrade cycle. The last quarterly reporting season that we saw actually saw some of the smaller downgrades that we've seen for a while. So I think people will be looking to mid-July to see what the outlook is from corporates, whether we are going to see a more stable environment in terms of forecast revisions, or whether some of this softness that we've seen in the PMI data will manifest itself in more downgrades.
I just find this fascinating, Lisa. It seems like Monday was ages ago. I mean, it's been it's Grego, but it's been an absolutely unique week.
And you raised a really good question, which is companies have been adapting and adjusting. They have been. So how much are we really going to see some surprise when this is the most telegraphed recession in the history of the world? And suddenly, the change this week to me, and Greg, correct me if I'm wrong, seems like people are resetting their expectations for how high inflation could stay and how high central bankers are willing to go and able to go with the resiliency of the economy. Do you think that that is a game changer? And that was sort of the tipping point, the threshold that was tipped this week?
I think potentially the view from our economics team has always been that the policymakers, the Fed in the U.S., are going to have to hike until they can find slack in the labor market. Slack in the labor market ultimately means unemployment going up, and that is what's going to trigger a recession. I think what's important for stocks is even if corporates are well positioned for this, and it's been a well telegraphed recession, when we look at valuations, it's not obvious that the market is well positioned.
What's your target on SPX?
3,400.
3,400.
Yeah, so we have one of the lower targets in the street, and really this is predicated on the idea of this recession actually materializing.
Are you on speaking terms with Carl Riccadani, your chief U.S. economist?
Yeah, just
Does
about.
he like calling recession?
Yeah, so Carl is looking for a shallow recession to manifest in Q3. So it's a slowdown in terms of real growth, but also inflation coming down. So it's quite a rapid slowdown.
So it's a nominal GDP story. This is important, folks. Nominal GDP comes in because both real growth and inflation come down, and then that gets you to an earnings statistic, which gives you 3,400?
Yeah, so what that drives really is a top-line slowdown, but then margin pressure that compounds that. So this kind of rapid drawdown in the bottom line against elevated valuations is what gets us there.
I have to say, what this call screams to me is earnings of NVIDIA, earnings of Microsoft, earnings of Meta that somehow disappoint and create that.
This screams to me that Brammo booked Bowdle. That's what it screams to me.
No.
Why don't you toss? Where's Pharaoh to save me? Toss another question at Greg.
Well,
I'm drowning in the gloom.
Quickly, is that really what you're counting on? It's a trigger to get all the way down to 3,400. You need to sell off in the big tech names. Is it going to be earnings?
To get to 3,400, what you can't have is the type of rotation that we've seen this year. What you need is a more correlated sell-off. So absolutely, if we get a recession, we think the cyclicals are going to lead on the way down. But what we also think is that you get broader participation in that sell-off. And we think that larger cap tech, it is defensive. They have quality balance sheets, but it is still cyclical. Some of those tech names are very exposed to the consumer. Some are exposed to the CapEx cycle. So if we see softness in the consumer, softness in the CapEx cycle, we think that translates to large cap tech down in absolute terms.
Greg Bowdle, thank you so much for getting us started today. So the BNP Paribas with Carl Riccadonna, and I just got an email, and yes, Bowdle and Riccadonna are in speaking terms. It's good to know. That's not true at most firms.
I will say that there is a shift. You can feel it. It was in the ether. We walked in. It was just sort of hanging over the office. Something had changed, and people weren't saying FOMO, and everything was just going to breathe upward forever and a day.
Switzerland, Norway, United Kingdom, and buried in it was the idiosyncratic realities of Turkey. Well timed. I think the finance minister of Turkey waits for Damien Sassower to come on before he puts out headlines. Turkey moments ago out with headlines here after a horrific 48 hours for the currency. Round it up, we're nearing 26 lira. It's not for me to say crisis in Turkey, but it is true. Things are unraveling. Turkey's Simsex's process conducted gradually. Stay with us. It's a most interesting Friday. Adam Posen later.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges.
Was next. Fed was going to keep rate while up. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
We have to get inflation back to target. We have to have price stability. And we've raised interest rates to do that. The economy has been more resilient. It's been stronger. We've seen we've got very low unemployment, but it is leaving us with inflation looking much more persistent. We think inflation is going to come down markedly this year, but there are signs of it being more persistent. And I thought it was right that we took this action.
The governor of the Bank of England decidedly not declaring victory yesterday. The British press is on fire this morning over this 50 basis point lift in interest rates, very different real estate dynamics over there. what it will mean for a broad swath of the United Kingdom public, really front and center within the media.
Did you hear Andrew Bailey's comments about what his recommendation was, the prescription for bringing down inflation? It was workers, ask for fewer raises. And by the way, companies, maybe don't try to expand your profit margins.
We don't have the time here to do this because Sassower is going to, he's like work from beach this morning, so we got to keep this short. But we're going to dive into this morning, folks. Basically, Bailey saying stuff that just could not be said in Washington, that this is because of irresponsible wage. I mean, I'm going to translate it. Irresponsible wage increases has led to inflation. That thud you heard was the entire macroeconomic community of the United States falling off their chair.
And it was also the thud of people getting ready to protest over in England. I mean, honestly, we heard this from Hugh Pill and it didn't go over well. It was sort of the let them eat cake moment of Britain. And so how much do we get some similar type of response to Andrew Bailey versus, you know what, he's right, he's just speaking truth. I mean, at a certain point, you can't say, you know, inflation's going up. Maybe if you just took a little more pain, you'd be okay.
We'll dive into this morning. Stay with us as you get to your weekend reading and try to dive into July of 2023. Damian Sassower is diving into 2025, trying to look ahead, particularly at emerging markets. He's our chief emerging markets credit strategist at Bloomberg Intelligence. Excuse me, Damian, I have to talk about the Turkish experiment. It's unraveling. Is it a Steve Hanke, Johns Hopkins unraveling of hyperbolic depreciation, or is there some measured unraveling to it as Semsek tries to right the ship?
You know, Tom, I got to be honest with you. I'm actually quite inspired by the move on the CBRT yesterday. I mean, look, 650 basis points is a big move, you know, and for those out there who thought it was all going to happen at once, good luck. I mean, this is going to be staged. So we're going to get 650 now. We may get 650 next month and may get even more the month after that. But eventually, with 44% year-over-year inflation in Turkey, we still have a ways to go. And so what's interesting is you rightly point out, we're almost at a 26 handle on dollar lira. I think Goldman, HSBC, and the rest were calling for a range of 24 to 25. I mean, we're already there. I think Morgan Stanley was the only one at the upper end at 28, calling for 28 by year end. I mean, we're close to it. So, you know, how much further does dollar try have to go remains to be seen, but there are strategists out there, Phoenix, Kalen, and SocGen, for one, who believe now's the time to buy.
Damian Sassower, in your world, there are usually two debt systems to a troubled EM frontier economy country, and that is a domestic system and the salvation of a foreign system of debt, usually wrapped around dollars. Is that system broken for Ankara?
Well, I mean, certainly, I mean, the difference between bank lending and deposit rates is massive, and banks can't survive with that discrepancy for much longer. I'm talking Akbank, Apikredi, Guarantee Bank. And so, yeah, I mean, but here's the thing. We talk about de-dollarization. There's voluntary and non-voluntary de-dollarization going on globally, Tom. In Turkey, it's what I like to call voluntary. You have households in Turkey that are hiding out in dollar deposits at Turkish banks as a way of sort of protecting their wealth or what's left of it after, you know, the policies of Erdogan over the better part of the last few years. That's not changing anytime soon. The conditioning is still there. People are not really believing what's going on with Mehmet Semsek and the new central bank governor. But nevertheless, you know, it is a step in the right direction, and I'm relatively inspired by it.
Wait, hold on a second. Inspiration means something, and buying means something else. Do you see opportunity here for Turkish lira, or are you just saying it's nice that they did this, pat, pat, pat? Still, avoid that like the plague.
Well, I liked it better when CDS, Turkish sovereign CDS, was at 700. We're now back to 513, Lisa. So we've come all the way roaring back. So no, I don't like valuations here. I still think there's going to be some pain ahead. And look, when you want to talk about pain, look at where cross-asset volatility has been. Look at what we're going. It's summer seasonals, weak liquidity. You know, it's that shift in the beta regime from inflation concerns to growth concerns. This is messy times. So anyone who's calling for new highs in the S&P, yeah, we may get it, but it's going to be on light liquidity, and I wouldn't trust it. So, you know, I'd be sitting on my hands here, quite frankly.
A lot of people talk about how this market or any market likes to inflict the maximum pain on the maximum number of investors. The trade for the first half of the year partly was to go into the emerging world and find assets. You could see that with respect to all regions out there. Is that going to reverse because we are suddenly seeing perhaps a decline in the number of rate hikes, even rate cuts in some of the developing world? while the EU, even the U.S., continue to double down on hiking those benchmark rates.
Lisa, yesterday at 7:31 Lex, our New York headquarters, we hosted our emerging market annual investment forum. I asked that exact question to people far smarter than I, including Diana Moe of Kirkoswald, and she said, as expected, it's all about the Fed. And so let's be clear. We've seen Norway, we've seen Canada, we've seen, the UK, sure. But all central banks are shrinking their balance sheets and liquidity is getting tight. And at what point does inflation kind of roll over or not? You, me, and Tom are not going to figure that out here on today's call. But I think, the reality is that is the pain trade in markets, is that inflation does not go away. There are going to be more rate cuts. I mean, 5.25 in Fed funds. My God, we never thought we'd be here. And here we are. And now markets are looking for 6. So, it remains to be seen. But all of that is certainly not good for risk assets and certainly not good for emerging market writ large.
Damian, you said it's all about the Fed. Earlier last week, we were talking to Peter Scheer about how the market is moving past the Fed and looking more at fundamentals and other drivers. Did that change this week? Perhaps it was for, a week or 2 weeks or 3 weeks where the Fed faded into the background. But if we shifted back into very much the Fed as the dominant player, given the fact that they could potentially raise rates further than many people ever expected?
Lisa, fundamentals don't matter. No, I'm kidding. No, I mean, look, they do. But really, you can't trade on fundamentals, certainly not in currencies and rates, because, it just takes, it could take decades for valuations to really manifest in those markets. So, you really can't trade value in those markets, but you can trade carry. And carry matters. Rate differentials matter. So you want to shift? Let's talk about China. China's a funding currency now. It's got an inverted forward strip. People are funding in yuan and taking risk in places like Brazil, Mexico, Colombia, all of which, Lisa, are overvalued at levels we haven't seen in years and years and years. And that's just not me talking. That's some of the people on my panel yesterday who were far smarter than I. So, look, we're in this environment where vol has come off. The carry trade is raging. It's working. And until it doesn't work, I think people are going to press that bet.
Damian Sassar, thank you so much. Greatly appreciate it this morning. Damian Sassar worked from home after working from Citi Field last night.
You think so?
Did you go?
I did not go.
I could see you there somehow. I could see you there. Doug down in Florida notes that the Dead played Alabama Getaway last night at Citi Field, so I should have been there. That's my fave of all time.
Were you a Deadhead?
I was not a Deadhead, but when I heard Alabama Getaway, it just jumped out at me. It was exquisite. There's just some craft there that's scary good. There's also craft that Anthony Dwyer at Canaccord Genuity publishing moments ago. He agrees with Greg Bowdle. He's really got a cautious view on where we're heading, and he just says all that we see here right now is becoming more likely. He says there's recession tendencies becoming more likely.
One thing we kind of glossed over here is the incredible dollar strength today. And it's a reversal of what we've seen for the past few weeks with some of the biggest gains or the biggest strengthening in the dollar versus some of the peers, like the euro going back to March. This is really a significant move at a time when people are pricing in the Fed and looking at weakness elsewhere. This, to me, is the game changer. Again, the market likes to inflict the maximum pain on the maximum number of people.
Also where we are in the calendar. And I think it's important. We're coming up on the year end. Everybody, mid-year rather, everybody has to justify their existence. We're beginning to see economic studies come out. I know JP Morgan's been out in the last 48 hours as well. But what I would focus on is what Greg Bowdle said, is this is all predicated on earnings cracking into the earnings reports, which you mentioned, I believe, is July 14.
That's JP Morgan kicking off.
And once again, it's very traditional financial study, which is you got to wait for earnings and see where they are. It's an extraordinary day. Richard Haas scheduled to be with us as well with the Council of Foreign Relations. Coming up, Dr. Piegza from Stifel. Stay with us. This is Bloomberg.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro on assignment, Lisa Abramowitz and Tom Key here on a Friday to get you to the weekend with some good Friday reading and thinking about where we are. As we said earlier, without question, the tide has turned in 48 hours, at least internationally, to a guess the recession tone. As Greg Bowdle stated from BNP Paribas, Lisa, we've been doing this for a while.
It's the reason why perhaps people shrugged it off, and perhaps people started to realize maybe it's not going to come. There is this resiliency.
Over a year? I think over a year.
And that's the reason why a lot of people didn't believe it, that it was actually going to come anymore. And then central bankers said, we have more work to do, and it's too much resilience.
Bruce Kasman out with the JP Morgan Love Fest, and to distill many, many pages, the pandemic promoted resiliency. I think it's a brilliant paragraph by the JP Morgan team, sort of navel gazing and saying, okay, what did we get wrong? And a medical event gave us the shock, along with Biden's stimulus, of a far more resilient ecosystem than anybody expected.
One of the most unprecedented aspects was the rolling recession type of narrative. This idea that one sector could suffer pain and another could experience incredible strength. And then it flips, which is the reason why I'm looking for the PMI data that comes out today at 9:45 a.m. in the U.S. Do we start to see the services sector, the main point of strength, loosen up the way that we did over in Europe?
Now, we're going to do this internationally today. Yes, Kasman on a global JP Morgan economy, but there's a domestic feel as well we're going to address right now, but we're going to keep our eye on all the international turmoil, particularly the European turmoil. And you really wonder what China does Sunday evening. Our time.
Yeah, and we've had the straight weekly loss that is the biggest for global stocks, at least going back 3 months. European stocks have had the longest streak of losses going back to December. There is a shift, even as Fed speakers talk about the potential for resilience. We got what we heard from Loretta Mester, Bostic, those on deck. Fed Governor Michelle Bowman yesterday was speaking, and she said this: I supported the FOMC's decision last week to hold the federal funds rate target range steady and to continue to reduce the Fed securities holdings. However, I believe that additional policy rate increases will be necessary to bring inflation down to our target over time. Tom, this is the belief. Even if some of these Fed officials supported a pause, they do think they need to go again, and that's sort of what we heard from Jay Powell yesterday as well.
No question about that, and I make joke about the speakers, but I agree the speaking tone here forward is going to really be key. No question about it.
Especially from Lindsay Piegza, who has been calling for benchmark Fed funds rates possibly above 6% based on the resilience that she was seeing. She's chief economist at Stifel. Joining us now, Lindsay, why is now and today different than 2 months ago when everyone was talking about recession and it evidently was nowhere in sight?
Well, I think it's different now because the Fed's message has been a bit more clear. The market was anticipating that the Fed would move to the sideline in this need to assess financial market stability, to assess the real impact of earlier policy initiatives on the real economy. But historically, the Fed has struggled to re-engage after moving to the sideline. So the market was beginning to anticipate that this was the terminal level, that the Fed may be nearing that final peak in Fed funds. But the commentary from the Fed is, no, in no way should this be seen as an end to policy firming. We were simply taking a temporary breather, a temporary stay in policy. And as you noted, even those Fed officials that supported a pause have been very clear that inflation is still elevated and the Fed will need to re-engage potentially as early as next month.
Lindsay, the importance of Stifel is a Midwest feel, and what the old Northwest from a million years ago. The view from Minneapolis, not from New York City, where we're navel-gazing at skyscrapers going under. Terrific Bloomberg story out this morning, I believe it was, on this commercial real estate debacle. Forget about that. Lindsay, what does your scenario above 6% do to the American housing market, ownership and rental?
It's going to be difficult. As we continue to see borrowing costs rise, interest rates rise, this is going to undermine affordability and valuations. So this is a hit to the residential as well as the commercial market. But the bigger risk is that the Fed loses its resolve in the face of this weakness and allows inflation to become entrenched. As we heard from Powell, yes, it will be painful for households continuing to, again, face those higher interest rates. But the bigger risk is that the households continue to face an erosion of purchasing power by allowing inflation to become entrenched. So it's a notion of short-term pain in order to get that long-term gain for the economy and getting back to a potential growth rate going forward.
Can the partial differentials of goods disinflation make up for a stickiness of service disinflation?
No, unfortunately, it can't, because the consumer has shifted back to that pre-pandemic preference for services. So during the pandemic, Americans were forced to stay in the confines of their homes. We were buying electronics, goods, stuff, anything to keep ourselves and our families entertained. But now, post-COVID, we've shifted back to a preference towards services, going out to eat, traveling, getting your hair done. And so right now, it's the service component that is primarily driving consumers to face those higher prices. And that's going to continue to drive the Fed's need to raise interest rates to tackle inflation.
Can I just say that her brilliant observation there of getting your hair done? In my next life, I want to come back as one of those people that dyes women's hair.
Okay.
They're like the highest paid people. They make more than Taylor Swift.
Why wait for the next life? You could start training right now.
I mean, Lindsay just nailed it there. That's the observation of the day. Do you know what that costs when 3 women go to the hair place and everybody needs to get a change in their hair color?
Do you have something you want to talk
There's
about?
There's like zeros to the left.
It's very specific.
Of the decimal.
What happens when you go to the restaurant and the napkin's a little bit over far to the left?
Lindsay nailed it there. Nailed it, I said.
So here's my question for you. You talk about how you need to see consumer spending roll over a little bit in order to bring inflation down. We heard from Andrew Bailey over at the Bank of England, his prescription, which is that people just need to stop asking for such high wages, such high wage increases, and companies need to stop being so greedy and increasing their profit margins that it's really shrunk during the pandemic. What do you think of that?
Well, I think the unprecedented nature of the pandemic led to a number of different inflationary variables. We see supply-side inflation, demand-side inflation, wage inflation, and to your point, corporate inflation or deemed greedflation, where we're seeing a gross increase in profit margins. And this also helps to explain that growing gap between the PPI, actual producer costs, and the CPI, what we're passing on to the consumer. But what this tells us is that it's a very complicated equation of inflation, and the Fed simply raising rates to a historically still low level is not going to be enough to get inflation under control. Now, to your point, the Fed's primary concern is that wage price spiral. Because labor is so scarce at this point, because we were paying people to stay on the sideline, because there's still lingering fear of the pandemic, or there's an inability to find that work-life balance, regardless of the reason, we're seeing millions of workers on the sideline, which is leaving businesses desperate for employees. So employees can demand those higher wages, but in response, companies are raising prices. And as consumers are forced to pay more in the marketplace, they demand even higher wages, and so on and so on. So that's what the Fed is trying to stem, trying to tap down that need for demand, tap down that level of investment in order to slow the economy. Remember, the Fed is looking for a slowdown, not necessarily an outright recession, but the Fed does want to see the economy slow, because only then can we see a slowdown in the demand side of the inflation equation, which is really the only component the Fed can control.
So I'm going to go out on a limb here and suggest that probably workers won't hear Andrew Bailey's prognostications and say, I guess I won't ask for such a big wage. And I guess that people in the C-suites aren't going to say, I guess we're going to just allow smaller profit margins. Janet Yellen said yesterday in an interview with Bloomberg that the odds of potentially a hard landing or some sort of recession have gone down because of the resiliency of the labor market. But she talked about the need for a slowdown in consumer spending, to your point. But Torsten Slok said the only way to get inflation really to 2% is to crush demand and slow down the economy in a more substantial way. Is this the reason, Lindsay, why you don't believe that we can get some sort of soft landing? Because in order for them to get to where they want to go, they have to make more progress than they've showed any signs of making so far.
Absolutely. And again, the notion that the Fed is going to back off from further policy tightening if we do see a slowdown in the economy is, again, that backwards thinking, because the Fed is trying to slow the economy. So when we see that first negative print, I think that will actually embolden the Fed that finally earlier policy initiatives are having the intended effect. So we may not see an extremely deep or prolonged downturn in the U.S., but we do need to see that slowdown, that first negative print, which we're still expecting by the end of the year or early 2024, despite that earlier resilience of the consumer in the first half.
But the raging debate here, and Lindsay, I'm going to get you out in front of the great Adam Posen here because you're so good at this. And I'm going to go to Northwestern University. Did you ever sit in a course with Professor Gordon, Robert Gordon? Did you ever have the privilege?
I did back in the day, yes.
Robert Gordon thinks this discussion is absolutely insane. The bottom line is, and there's a lot of out in the media this morning on his folks, is Bailey's living some Keynesian redo from a previous century about wage dynamics. There's a lot of American economics that just simply says that's nuts, right?
Well, I think it's a difficult argument because we still are seeing the traditional metrics of, again, that scarce resource in the labor market. That's what it comes down to. Unless we see a meaningful pullback in demand for workers, meaning investment has slowed and businesses are shuttering their doors, or we see a significant influx of the labor supply. So we're pulling those sideline workers back into the labor force. Unless we see one of those two dynamics, I don't see a case for finding that clearing mechanism where we can begin to see wages settle back down to a more sustainable level that allows the Fed to get that would allow the Fed to get back to that 2% level of inflation.
This is why Dr. Peegs is on, folks.